Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Here's a fit of the price action this Wednesday, 3 hours away from the opening bell. Equity futures doing okay on the S&P, up 0.1%, doing better than okay in the equity market over the last couple of weeks. From the lows of November, we're up about 8% plus on the S&P. From the lows of November on the NASDAQ, Tom, up 13% and some.
You're making some jokes about it, but John, seriously, this is a time to look at the Standard & Poor's 500. There's enough disjoint in the NASDAQ, profit NASDAQ, less profit NASDAQ, and huge disjoint in quality and Dow and all that dynamic that I really think you've got to look at some form of balanced index to see where you are.
Do you want to see some disappointment? Target. Third quarter adjusted EPS 154, the estimate 215, and here come the cost cuts. How many times have we been talking about this? It goes beyond retail too. We've been talking about big tech and all the cuts they're making. They're seeking up to $3 billion, Lisa, in cost cuts. They cut their 4Q top line, bottom line expectations just across the board here. Not a great read.
One of the most interesting things is they actually beat in comparable store sales, but they've missed on online sales. How much are we going to see this as the online competition really heats up, and how much people are going back to stores, but not necessarily the online footprints? Again, the tech infrastructure built out, how much is that going to really struggle as people take a look at really the demand on that side?
The stock hammered. We're down by more than 11% at 158.16. Target's had a tough year around earnings, TK. It just has not been pretty.
And what's great about this, folks, is they do a wonderful set of headlines. I wish every other company was as articulate as they are when they launch 30, 40, 50 headlines. What I see here, John, is massive uncertainty. Isn't planning layoffs is part of efficiency push centered around low single-digit drop. I love this, John. Initiative to simplify and gain efficiencies. I guess that's technology to the rescue because they don't know what the outlook is.
Do you remember May, when they came out in May? It was May 18th. I'm just looking at the numbers now. The stock was down 25%, Lisa, off the back of that. So they had this big inventory problem. And that's when we started to think about goods disinflation in the months to come. We're starting to see that evolve at the moment across the retailers and in the CPI basket too. Now we're talking about cost cuts. And this is starting to build. Lisa, starting to build, and it's going across a range of sectors, I would say, not just technology, also retail and elsewhere too.
And you raise a good point about execution. How much is this just a mix of goods, and how much is this perhaps being overstocked? But Walmart cleared it out, and Target isn't. And I want to point to this nugget within the data. The customer transactions were up by 1.4% versus the estimate of 12.9% year over year. Basically, how much are people buying more on a dollar percentage basis simply because of inflation, but they're not transacting as much? How do a lot of other companies deal with the fact that consumers are being much more cautious with respect to what they purchase?
Do we all agree this is recent? It's the uncertainty that you see in these headlines, John, signifies to me that this is a recent 2-week, 3-week, 4-week uncertainty about how to get to Q1 next year.
We've seen this in Home Depot too.
Yeah.
Average ticket was 9% higher at Home Depot. Transactions actually declined by more than 4%. So you see that mix shifting as well.
Trading range 178 on the close down to 155-ish. That gets it near the low. 145 maybe is the last summer a support level. To breach 145 would be a big deal. We're not there yet, but certainly we made it back 3/4 of the way there in a heartbeat.
Target down 13%, Tom, in the pre-market. Not pretty numbers from them this morning.
And of course, it links into the American economy. It links in to consumers. 70% of the American economy and retail sales. Lindsay Piegza is expert on this, chief economist at Stifel. How are retail sales, Lindsay? Cut to the chase. How rapidly have they slowed?
Oh, they have slowed precipitously after that near 3% increase at the start of the year, really boosting confidence of the resilience of the consumer. We've seen weakness not only continue, but intensify. If we look over the past 3 months, the average pace is essentially flat. So consumers are dramatically pulling back. They're, in some cases, cutting back on the nominal amount that they're purchasing. In some cases, they're reducing the quality of the goods that they're purchasing, maybe going from brand name to Walgreens brand. And for some, we're seeing this phenomenon that we've deemed binge spending, whereby we're cutting back to the bare minimum for 1, 2, or even 3 months in order to buy that larger ticket, more expensive item in month 4. But regardless of the form that it's taking, consumers are dramatically shifting the goods and services in their basket, something that we do as shoppers when we're increasingly concerned about our financial footing.
Is your nominal and real GDP analysis, is it hinged on consumer dynamics, or do you have to look, for example, at investment dynamics or trade dynamics? Is it all about the retail market?
Well, it all plays into our GDP forecast, of course, but the consumer is, as you mentioned, 70% of the economy. So if the consumer is not happy and healthy out in the marketplace, it doesn't matter how much businesses are investing or a temporary boost to inventories or net exports. We have to see the consumer in a healthy position. And right now, individuals, households are under an extreme amount of pressure, facing negative real income growth and, of course, still elevated prices. Now, we have come off of what looks like to be peak levels of inflation, but we're still talking about multi-decade highs. And that's going to be a sizable burden for consumers, particularly as we now see that holiday shopping season, that key shopping season upon us.
Why isn't this enough, Lindsay, to bring down inflation in itself?
Why isn't 375 basis points enough? Well, I think it.
Why isn't the pain that we're already seeing, the retrenchment, the fact that people are seeing their real wages lag behind inflation, why is that not enough at this point, given the margin compression, given the fact that companies talk about this weakening? Why is that not bringing down inflation faster, or why won't it into next year?
Consumers are still spending. We have seen a slowdown, but it's that second derivative decline. It's a slower pace of still positive expenditures. And so, yes, consumers have slowed from an 8% average pace last year to 2%, but we're still seeing money flow into the marketplace. And so there needs to be additional pain felt to really bring down price pressures back in line with what the Fed is looking for in terms of that 2% target. Again, we're taking steps in the right direction, but you also have to remember that the household balance sheet was in incredibly healthy shape in the aftermath of COVID. Many individuals paid down debt. Then you layer on the trillions in savings or that accumulated wealth cushion. And so consumers had a number of factors supporting them artificially, independent of this negative real income growth that would continue and will continue to support them potentially for several more months going forward before we really see the true full impact of higher borrowing costs filter into the economy.
Lindsay, Esther George of the Federal Reserve basically talking to the Wall Street Journal, the Federal Reserve president of Kansas City, how much she's also seeing something similar to what you're saying. Basically, the consumer is very strong, and for this reason, tiptoeing around the word recession, but basically saying there might need to be a severe recession. What's the contour of that downturn from your view? Is it short and shallow? Is it shallow and long? Is it steep and short? How are you seeing it?
Well, I think it's going to very much depend on the Fed's pathway to higher interest rates. If they slow play this, if they slow the pace of rate increases and draw this out, I think this could be somewhat of a shallow recession, but more prolonged period of downturn. If the Fed keeps their eye on the ball and remains resilient in their commitment to reinstate price stability, keeping larger rate hikes in place, I think maybe we see somewhat of a more sizable drop in a quarterly basis, but we could be talking about coming out of this downturn much sooner than the former scenario.
Lindsay, if we have unit in price and business is slow for whatever reason, price comes down. How does retail, Target, and the rest of them, how does that change your inflation call? I mean, is it inconsequential? Is it tenths of a percent? What's that dynamic?
Well, I think we have to be careful. What we are seeing is some disinflation in less desirable goods. Remember, businesses were hoarding parts, materials, goods at the start of the year in order to have enough product on their shelf for this presumed resurgence of the consumer. But consumers now are dramatically shifting what they're purchasing and how much they're purchasing. So many businesses like the Targets, like the Walgreens, are sitting on inventories that are maybe less desirable for consumers right now. And so some goods are going to see some downward price pressure as businesses try to eat through that existing stockpile. But broadly speaking, I don't think that segment of repricing is going to impact the broader level of prices in the economy.
How much does the fact that higher income individuals have a lot of savings and lower income ones do not keep the inflation picture going longer than perhaps certain entire swaths of the population can handle it?
Well, I do think that you're right that the savings component is skewed to the upper, to the middle and the upper income earners. However, on the lower end of the spectrum, we still saw a sizable wealth cushion as we saw a state and local stimulus, a sizable fiscal stimulus, a moratorium on rents, a moratorium on student debt payments, the enhanced child tax credit leading to an additional check in many people's mailboxes, not to mention just the nominal way that we shifted how we work, how we live, how we commute. All of that did lead to a sizable amount of wealth, even at the lower end of the spectrum, all of which, again, is continuing to provide at least temporary artificial support to the consumer up and down the spending ladder.
Hey, Lindsay, wonderful to hear from you, as always. Lindsay Pieksa there, the chief economist at Stifel. I want to return to a quote that Tom referenced a number of minutes ago, just a moment ago, from Brian Cornell of Target. In the latter weeks of the quarter, sales and profit trends softened meaningfully, with guest shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty. And Tom, this resulted in a third quarter profit performance well below our expectations. To your point, TK, and you mentioned this when the numbers came out, just how quickly is this story moving? How quickly is that weakening starting to show up in some of the numbers? Or to Lisa's point, do we just have an execution problem over at Target?
Well, there's Target, and that's retail as well, but I dovetail it with the housing market as well. I mean, we're talking about T-shirts at Target or whatever's in aisle 14. But, John, you dovetail it into shelter as well, and you got two movable forces here reacting to this slowdown.
Lisa, stock right now down 13% early trading.
You raise a great question. Is this a Target story, or is this a broader retail story that's going to have legs? And clearly it is highly speaks to the fact that Walmart executed something well. Target has been performing perhaps not as well, but really this does hint at something broader.
Coming up on this program, we're going to catch up with Elliot Ackerman, the former White House fellow and U.S. Marine Corps veteran. Looking forward to that conversation as we await a news conference with the Secretary General of NATO, Jens Stoltenberg. When that begins, we'll bring you some headlines. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has told allies at the G20 summit that it was Ukrainian air defenses that caused that explosion in Poland. Still, he said that a massive Russian missile attack on Ukraine was ultimately to blame. Poland's president agrees, calling the matter an unfortunate incident. The explosion killed 2 people in a Polish village not far from the border with Ukraine. Donald Trump has made it official. He will make a third run for the White House. The former president made the announcement Tuesday night at his Mar-a-Lago resort in Florida. That comes a week after a number of candidates he endorsed lost in midterm elections. Meanwhile, many Republicans are now looking for another representative for the party. The hit video app TikTok is investing heavily to address U.S. concerns about data security. The company is partnering with Oracle to isolate sensitive data from its American users. TikTok's CEO spoke at the Bloomberg New Economy Forum in Singapore.
we're going to move the data that we store in Virginia and in Singapore into Oracle's cloud infrastructure. That's our partner. Oracle's going to look after it for us. We're going to have new and improved data access protocols such that only an entity of U.S. residents that in the U.S. will have access to a certain set of U.S. protected data.
Former national security officials still believe TikTok users would risk having personal data exposed to hackers and espionage by China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
happening right now, a briefing with the NATO Secretary General Jens Stoltenberg. Let's listen in.
Yesterday's explosion took place as Russia launched a massive wave of rocket attacks across Ukraine. Since the start of Russia's illegal war in Ukraine, NATO has increased vigilance across our eastern flank, and we are monitoring the situation on a continuous basis. An investigation into this incident is ongoing, and we need to await its outcome. But we have no indication that this was the result of a deliberate attack. And we have no indication that Russia is preparing offensive military actions against NATO. Our preliminary analysis suggests that the incident was likely caused by a Ukrainian air defense missile fired to defend Ukrainian territory against Russian cruise missile attacks. But let me be clear, this is not Ukraine's fault. Russia bears ultimate responsibility as it continues its illegal war against Ukraine. In the meeting today, NATO allies offered their deepest condolences on the tragic loss of life. They expressed their strong solidarity with our valued ally Poland and made clear that we will continue to support Ukraine in its right to self-defense. Russia must stop this senseless war. Last night, I spoke with the Polish President Andrzej Duda and with US President Joe Biden. We agreed that we need to stay vigilant, calm, and closely coordinated. We will continue to consult and monitor the situation very closely. NATO stands united, and we will always do what is necessary to protect and defend all allies. And with that, I'm ready to take your questions.
We start with Polish radio, lady in grey at the back.
Jens Stoltenberg there, the NATO Secretary General, saying the investigation is ongoing. There's no indication this was deliberate. The preliminary analysis is that the incident was likely caused by Ukrainian air defense. He went out of his way, Tom, to stress that he does not believe this is Ukraine's fault, that Russia bears the ultimate responsibility. And we wrapped it up at the end there, TK, by saying we need to remain vigilant, calm, and closely coordinated.
Vigilant, and again, the size of the attack by Russia, which of course we've seen any number of times there. We'll continue to monitor the story with our team in Brussels, including Maria Tadeo. Right now, in perfectly timed, and of course we did not know of a rocket attack, Elliot Ackerman joins us to say he's former White House fellow, U.S. Marine Corps veteran, is to miss the point of my book of the summer a number of summers ago. The book is 2034, A Novel of the Next World, except the next world is coming ever closer. Elliot Ackerman, thank you so much for joining us today. Let me start with the basic reconnaissance issues of a missile attack. Do we have, as the West, or as America, or as NATO, do we have intelligence systems from space or from ground that know where various and sundry missiles move?
We do. Generally speaking, what we have is what's called counter battery radar. So you can, with basic math, figure out the trajectory of these missiles, the direction of impact, and where they have come from. So, I mean, that's basically how we've seen NATO very quickly figure out that this missile that landed in Poland was in fact launched from Ukraine.
The dystopian nature of your book, 2034, without giving the plot away, is that when adversaries come together, the biggest problem is mistakes. The biggest problem is risks. As you perceive Ukraine and Russia into the winter, is that the problem? They're worn out, they're exhausted, systems are failing, they're just close. So like your book, things fall apart rapidly?
Well, exactly. You hit the nail right on the head that, wars are escalatory by nature. And once you enter this escalatory cycle, it just picks up, and each incident becomes increasingly dangerous. And that's why we see the Secretary General of NATO cautioning calm, because all sides don't want to see the war in Ukraine spill outside of the borders of Ukraine, which would be disastrous.
Elliot, that calm wasn't there yesterday. The foreign minister of Ukraine put this tweet out 14 hours ago. I want to read it out because I think it's important. He said, Russia now promotes a conspiracy theory that it was allegedly a missile of Ukrainian air defense that fell on the Polish territory, which is not true. No one should buy Russian propaganda or amplify its message. Hasn't that just been totally contradicted by the NATO Secretary General just moments ago?
Well, it has, and it's an important reminder that although Russia is waging an illegal war in Ukraine, and although the West and NATO are supporting the Ukrainian people, it obviously has to be within a rational context. We can't go fly off the handle each time that there is an incident or the war spills over in unfortunate ways. So I think NATO is doing the right thing. I wouldn't necessarily say the Ukrainians are doing the wrong thing, but I think you can expect, they are in a crisis situation that a reality they've been living in since February of 2021, an existential war fought on their land, and we need to be good partners in helping them manage that war and hopefully bring it to a successful conclusion.
Does it bother you, though, Elliot, that perhaps Russia has a bit more leverage because they're backed into a corner and it's Vladimir Putin's pride, and he could act in a more rash way because he doesn't really care what the West does to him at this point because of just simply their reluctance to engage in a conflict?
Sure, I think that that is obviously a point that we need to weigh. Russia is backed into a corner. Putin, it would seem, doesn't have that much left to lose. But if you want to look at the nation that really has nothing left to lose, it's Ukraine. Ukraine is fighting for its very existence and its very life. The thing that concerns me the most is that I think by we, I mean sort of the collective West, have in the last decade or two of warfare gotten into a psychology where wars are very long. They're fought over 5, 10, as we saw in Afghanistan, even 20-year periods. The war in Ukraine is a different type of war. It's a bit of a throwback. When I've been there to cover the war, there are air raids. You're running down to bomb shelters. It feels like a 20th century war. And it's a war that needs to be resolved really in the next year or two. And if the war bleeds over into 3, 4, 5, 10 years, that only advantages the Russians.
Elliot, wonderful to hear from you, as always, sir. Elliot Ackerman there on the strike that hit Poland yesterday, Tom. And what we understand from the NATO Secretary General Jens Stoltenberg is that A, the investigation is ongoing, but B, no indication it was deliberate, and C, no indication Russia is preparing to attack NATO. But ultimately, the conclusion, the blast likely caused by an errant Ukraine air defense.
And more on this, I can't say enough, John. 2034, it's coming ever closer, every moment.
Live from New York City, heard on radio, seen on TV, this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on outputs. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
As much as 100% of people thought we're going to have a recession next year, maybe 100% of people thought you need to buy into this rally.
The Fed might start to throw cold water on this rally.
As soon as you're expecting a hard landing, then I think the earnings recession almost has to follow through in this situation.
The question is how quickly we will get closer to the kind of target central banks are pursuing.
Inflation can come back down quite quickly, but history suggests that that's an outlier.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Executive decision. Christmas tree. It's going up Friday. Just so you know, TK. We're going early again.
Out front.
Making it
so
happen.
Tacky.
Making it
just,
happen. Did you just call me tacky?
You see the... Come on. You don't do
need
Christmas.
A long runway.
You don't
you
do...
need 2 months, 6
man.
weeks.
Lisa, help me here.
Of celebration.
Oh, yeah. I'm really the expert on Christmas trees.
Unchanged on the S&P 500.
Really want to go there?
That was good. Live from New York City this morning. Good morning. Good morning. Equities unchanged on the S&P. Target anything but. Earnings from Target out about 30 minutes ago. And TK, it's fair to say they were a disappointment.
The Christmas trees at Target will be on sale. The fake ones with a little wheel spinning around, and the live ones cut in Nova Scotia and transported
Are you suggesting
in.
that I've got a fake one and it's tacky
Yeah,
and it's got spinning wheels
exactly. But at Target, everything's going to be on sale. They got to move the inventory out. But what's important is this is not about finance. It's not about ratios. It's about the emotion that we heard from their executive officers.
It's about a consumer. Brian Cornell, the chairman and CEO, said this, Lisa, in the latter weeks of the quarter, sales and profit trends softened meaningfully, with guest shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty.
And it does come down to which companies are big enough and have the best negotiating power with both suppliers, with employees. It has to do with execution, and it has to do with consolidation at the biggest companies. How much do we see a real dispersion now among the weaker players and the strongest ones that are able to withstand what's going to be a rocky period of time?
Absolutely dead on. We're seeing a partition here. I'm going to go to the zombies or partial zombies, whatever, and those that can get it done. $3 billion in costs, and they're not laying off. How do you execute that?
Where does it come from? I know. Retail sales 90 minutes away. Tom, we need to talk about what happened in Poland yesterday evening as well.
Yeah.
The blast that took the lives of 2 individuals very close to the border with Ukraine and the frontier there. This from the NATO Secretary General literally 10 minutes ago. The Polish blast likely caused by an errant Ukraine air defense system. So there you go, Tom.
And Elliot Ackerman just on with us with his book 2034 with Stavridis, making very clear this is what happens when you get the exhaustion out from February of 2021. The war's getting longer and into the cold that we see of this November.
I stress this is preliminary analysis, but Tom, this is slightly problematic because that line contradicts what we heard from the Ukraine foreign minister late yesterday. And there are some people very concerned about Ukraine. And Tom, I won't say misinformation, but moving too quickly and maybe causing a little bit of alarm at the wrong time.
I go back to this is a war. It's not something stage managed.
And this is what happens, and calmer heads have prevailed.
This is what happens, and it on both sides, you wonder what the Russian reaction will be to this as well.
It also highlights the tenuous situation and the reason why we saw such a reaction in markets, because you've got desperate nations. You've got Ukraine desperately trying to preserve its ability to be a country, and you've got Russia with Vladimir Putin desperate to maintain a sense on the world stage of not losing, right? So if you've got two desperate nations that want to bring the rest of the world in, how does that leave us in terms of feeling calm heading into the winter?
Couldn't agree more. Equity futures right now unchanged on the S&P 500. Let's whip through the price action briefly. What a rally we've seen in this equity market, Tom. On the NASDAQ, on the S&P, we just take a pause ahead of retail sales a little bit later this morning. Yields are unchanged on a 10-year, 377.51. But Tom, they were at 430-something. Not so long ago. And I can tell you the 2-year was pushing 480
we're talking
a couple
5%,
of Fridays ago. And we've come down about 50 basis points across the board.
I would blend it in, folks, and I think you have to do this now, John, across equities, bonds, currencies, commodities into the Bloomberg Financial Conditions Index. If it's good enough for the IMF, it's good enough for us. And the fact is we've become nicely more accommodative and away from restrictive with the dynamics over the last 2 weeks.
Amazing, Bramo, to see what's happened in the FX market as well. Reclaiming things like 104 on euro, dollar, 120 on cable. Across the board, that dollar weaker.
Yeah, and how much is that going to be a theme heading into 2023, that we are going to get some sort of peak in the dollar? Today, what we're looking at is a host of Fed speak, including New York Fed President John Williams, Michael Barr testifying in front of the House, Fed Vice Chair for Supervision, and then Chris Waller later tonight, Fed Governor, talking about what to expect going forward. Esther George out in the Wall Street Journal talking about the expectation of something that sounds a lot like recession. I am expecting more of that in terms of just how hot the economy is and how much they'd like to see it cool off. At 8:30 a.m., the latest read on the consumer U.S. retail sales for the month of October. We are expecting them to come in artificially hot. And I say that because of car sales. They're expected to come in bigger than expected because of the storms in Florida and people replacing some of those cars. So stripping those out will be interesting to see the underlying momentum. And today, the earnings that we've already gotten Lowe's and Target. Mixed pictures, Lowe's doing better, Target doing a whole lot worse after their disappointment, and really a sense that things are not going well for them, even as Walmart outperforms. And TGX is going to be reporting in a couple of hours. NVIDIA aftermarket, John, I think will be interesting, given chip situation and given what we've seen in Apple. We're hearing them shift their chip suppliers over to a little bit more in the United States, to Arizona. We've heard them actually giving deals, unlike what they've given in recent history, in order to get some of their iMacs moving. A lot of questions around some of the tech sector and how much they can continue to deliver these incredible results.
Elisa, thank you. Great as always. And as far as Apple's concerned, Tom, this from Jefferies on the factory shutdown over at Foxconn in China. Apple is taking an estimated impact of about $1 billion in revenue and 1 cent in EPS per week of lockdown. $1 billion in revenue per week of lockdown.
And the scale here is important, but as you've mentioned any number of times, John, this is not only about the making of said phones in China, it's the selling of said phones in China. I think most Americans don't realize the success of the company in Greater China.
Huge. And we'll be talking about it, I imagine, into Christmas and beyond. Amy Silverman joins us now, equity derivative strategist at RBC Capital Markets. Amy, can we call this a melt-up over the last week? And what do you make of this rally we've seen from the NASDAQ to the S&P?
Yeah, I think melt-up is an accurate way to describe it. Look, it feels like a lifetime ago, but, 1 week ago is when we got that CPI number. And options were, somewhat of a culprit outside of fundamental information. About 1/3 of all S&P options that traded that day were for that expiration on that Wednesday. And that certainly exacerbates some of the moves you see. Now we've gotten to a point, John, in terms of positioning where, essentially investors are selling calls and basically just watching a grind up. So, they were very worried about participating in that upside, but we haven't seen reinitiation of even new levels from here. So I think from the options perspective, they kind of think, again, it's a melt up, but not a rip up.
Amy, I'm going to go to your research note where you mentioned Bitcoin in your study of the Bitcoin moves and all the uproar that's ensued. And I want to go to quantitative finance and this concept of drift, of moving tick by tick in a time series. Does Bitcoin trade like Apple? Does Bitcoin trade in a time series like a given bond or a given foreign exchange pair? What does the drift look like for Bitcoin?
Yeah, you know, look, for something like Bitcoin and crypto in general, there's obviously not as long a time series as there are for other assets, but the way it trades, when you look at it historically and you look at realized correlations, is it's just another risk asset. And certainly given the information that came out of FTX and everything that's going on, you know, people want to know what direction it's going. And I will say, similar to all other risk assets, Tom, you know, on the downside, it tends to be more correlated. So we're seeing decently strong correlations, you know, as the market had sold off, and it still remains strong, but it doesn't, you know, on the upside, it actually tends to diverge more than downside. All things tend to go to one when things are, you know, selling off very hard.
Amy, we've been talking about how incredible the swoon in Bitcoin has been, but you point to the other side of things, that actually it's been quite resilient, just the crypto space in general, given the entire collapse overnight of an entire firm. I wonder if there's a broader message about the markets and just how resilient and how invested a lot of institutions are, not in the crypto space, but more broadly, and the reluctance to really retrench in a meaningful way.
Yeah, it's a great question. And look, a few months ago, we spoke with both Sam Bankman-Fried and Brett Harrison, who was the president of FTX at the time. And I think one thing that's underappreciated, Lisa, about what they were doing was not only on the crypto side, but there were huge implications for just market structure, for just normal markets, for futures, for derivatives. And the other thing I would say is, you know, like, given where the CFTC proposal is likely in now, it's probably not going to pass, or at least regulators are going to look at things differently. But the resilience, to me, seems to speak of kind of the institutional adoption that did happen, because there was a lot of interest at the time, and, you know, we'll see how that changes. But institutions, and this has been a theme that they've talked about a lot, was institutions continue to adopt, continue to investigate it, continue to have heads of digital. And I don't know that that would change even with where FTX is now.
Amy, wonderful to hear from you. Brilliant as always. Amy with Silverman there of RBC Capital Markets, with futures turning just a little bit lower, Tom. We're down a little more than 1/10%.
I noticed that she is a former strategist at Citadel, so she's got a nodding acquaintance with what
she might know what she's talking about.
I don't believe in her research note she outright says Bitcoin south to a lower price, but she makes very clear that if you choose to bet Bitcoin south, one way to do that is with the correlation to buy the VIX calls, where you're predicting VIX goes 24, 26, 28 in that tension.
I'm not sure how many people will be suggesting a Bitcoin allocation at the committee meetings going into year end.
Is that part of the 60-40 split?
The reputational risk around investing in some of these platforms now is huge. It's huge.
We've had an outpouring of both visible and less visible to Bloomberg surveillance on this. And John, I just can only say we've tried to be responsible from the very first conversations that I've had on Bitcoin years and years ago. I'm going to not mince words. My go-to on this is Raphael Auer of the Bank of International Settlements, who published 2 days ago.
You see Rubini on this, heated, to borrow a phrase, Tom, of yours.
We are in the news business. Mr. Rubini is in the sell his magnificent new book business.
It's a great book.
You and I and Lisa, we need to be collectively careful at this moment.
You think?
I would suggest.
I'm just saying he was heated.
I'm still going to call it bit dog, but that could be north or south.
Futures right now down 1/10% on the S&P. Retail sales in America coming up a little bit later from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. NATO says that explosion in Poland was likely due to Ukrainian air defenses. That blast killed 2 people in a Polish village several miles from the Ukrainian border. The Secretary General of NATO, Jens Stoltenberg, says the blast was probably caused by a Ukrainian missile fired to defend against Russian cruise missile attacks. Donald Trump has made it official. He will make a 3rd run for the White House. The former president made the announcement Tuesday night at his Mar-a-Lago resort in Florida. That comes a week after a number of candidates he endorsed lost in midterm elections. Meanwhile, many Republicans are now looking for another representative of the party. The European Central Bank warns that record inflation spells trouble for everyone from households to governments. The ECB said its assessment is that risks to financial stability have increased.
We are going to see lower growth. We are not ruling out the possibility of a technical recession and higher inflation. And simultaneously, the monetary policy response to higher inflation is giving rise to a tightening of financial conditions. I think that this is the main factor, and sometimes we have to try to look beyond, to look through what are short-term movements in the markets.
The UK said today that inflation in October reached a 41-year high, 11.1%. And shares of Target, they are plunging today. The retailer's third quarter earnings came up short, plus it cut its fourth quarter expectations for both sales and profit. Target is now looking to cut $3 billion in costs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. Of politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
with unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority. Global inflation and recession, an energy crisis intensified by war, and the aftermath of a pandemic. Today, world leaders are meeting in Bali for the G20 summit, and Bloomberg is there bringing you the news and analysis.
A confluence of economic, climate, and security crises make it a uniquely challenging time.
All of these are pointing towards a big slowdown in trade.
It all starts today, only on Bloomberg, your global news authority.
Investigation into this incident is ongoing, and we need to await its outcome. But we have no indication that this was the result of a deliberate attack. And we have no indication that Russia is preparing offensive military actions against NATO.
Jens Stoltenberg there, the NATO Secretary General, went on to say that the Polish blast was likely caused by an errant Ukraine air defense missile. Tom, that news conference took place about 20 minutes or so ago. Got some news here from Axios I wanted to share with you all. I think this is really important. From Stephen Schwarzman of Blackstone, in a statement to Axios saying the following: America does better when its leaders are rooted in today and tomorrow, not today and yesterday. It is time for the Republican Party to turn, Tom, to a new generation of leaders, and I intend to support one of them in the presidential primaries.
It's going to be interesting to see, and I think what's important here, John, is it's overlaid, and this is Mike Allen writing this up smart with brevity. It is about Mrs. Kushner, Ivanka Trump, with a heartfelt statement yesterday, and then Bloomberg's interview with Mr. Griffin, same idea. But I would suggest that Mr. Schwarzman of Park Avenue and Blackstone carries more weight even than Ken Griffin.
Defecting from former President Donald Trump, to your point on Ken Griffin, had some pretty strong words to say yesterday, didn't he, Bramo, when it came to Ron DeSantis, and for that matter, I think he referred to the former president as a three-time loser.
Right, so this is basically going to be the supporters.
You called me that last week.
Pulling away, and how much do you get this, how do you get the voters on board? Because a lot of voters still support the former President Trump, perhaps not enough to give the wins that they'd like, but there still are a lot of people who support him. So what do they do? How do they bring them into the Republican fold?
I believe to that point, in the last election, he got more votes than he got in 2016. He lost, but nevertheless,
these primaries are going to be something in America, that's for sure.
Well, they're going to be on both sides. It's going to be interesting to see. Of course, we'll hear from the president. Maria Tadeo's in Brussels, of course, looking at all going on with Poland, and for that matter, in Brussels as well. Anne-Marie Horton is in Bali with the president, and it is in a G20 meeting of many stories. Anne-Marie, I have to go domestic as well. These donors are speaking on the former president. Is the money of voting, is the money of politics so great that it will change in any way the path for Donald Trump?
Well, potentially, right? He's not getting these big endorsements. First, it was Ken Griffin calling him a three-time loser this week in terms of election losses, talking about the candidates Trump really backed that were not able to flip or maintain Republican-held seats. And then, of course, you have Steve Schwarzman today wanting a new path, and even his own daughter saying that this time around she wants to focus on her family and her young children. Even though she loves her dad, she doesn't want to stay in politics with him. So it does seem like this big Wall Street money, these backers, Trump is losing. But it's not just the money. There's also individuals he's losing, right? You would think that his former vice president would get behind him, right? That's not happening. Mike Pence is charting his own path. He's on a book tour. He's talking about potentially insinuating his own run for president. There's his former Secretary of State, Michael Pompeo. He has insinuated the same. And then, of course, there's that individual in Florida that he's elevated 4 years ago that really crushed the midterms, and that was Ron DeSantis, where all the Wall Street money and some of the smart Palm Beach money is going towards. So it's not just the money, it is the individuals. And Lisa brings up a good point, though. Will this be enough for the fact that he does have almost a cult-like base that follows around these rallies? will they come into the fold and support who the more mainstream Republicans decide to go for?
Domestic politics from Indonesia, we must look at a war that intrudes on all of us. Maria Tadeo is in Brussels. Maria, what has changed since the speech, the comments, the press conference of Mr. Stoltenberg?
Look, Tom, I think there's a lot of relief. You know, the fact that the head of NATO says for the time being, this investigation at least shows that there was no direct intent from Russia to attack a country like Poland on purpose, of course, means that there's a lot of relief, not just here in Brussels, but really across the alliance. Remember, at one point yesterday, there was serious concerns that we could see now a bigger conflict. That's always been the risk, that this war may not be easy to contain in Ukraine. This is happening in the heart of Europe. I think today there's relief now that for the time being this has been contained and the nightmare scenario has not really manifested. But for a lot of Europeans, however, and this I really want to stress, it has been an eye-opener. This war is happening in the heart of Europe, is active, it's brutal. Yesterday, the power went down across Ukraine. The neighbors also had blackouts. The fight here is very intense, and the hypotheticals of a spillover, well, we see they're not just hypotheticals on paper. They're very real.
Maria, wonderful to catch up with you. Maria Tadeo there, alongside Anne-Marie Hordern. The latest investigation then, it's ongoing, but what we've been told is no indication this was a deliberate act, no indication that Russia is preparing to attack NATO. And the preliminary analysis suggests, Tom, the incident was likely caused by a Ukraine air defense missile.
Well, we heard from Mr. Ackerman, with all of his experience as an officer in the Marine Corps, that there's a lot of intelligence on this, and I can't remember the exact language, but he basically said it's math, and they've got the intelligence to look at trajectory and vectors and all that to know precisely.
The fog of war, Tom.
Yeah, that's what Stavridis would say.
They were worried about this for a while, that something like this might happen.
Well, yeah, this might happen, but what's so important here, particularly in talking to James Stavridis, former NATO Supreme Commander, there's multiple thises. John, right now, as I speak, there's 20 thises out there. And again, I've always come back and focused on the Black Sea from Crimea over to Moldova. And the bottom line is the uncertainties there, the closeness, the bad events that can occur are all tangible.
We'll return to this through the morning, of course. Also returning to what's happening with Target. The numbers from them, let's face it, dreadful. The stock getting absolutely hammered going into the opening bell. Equity futures just about unchanged on the S&P 500. The next stop for this market, Lisa, is retail sales. You've talked about it all morning. It's about an hour and 5 minutes away.
How much are we already getting a preview, though, with the Target earnings and with the Walmart earnings? It's sort of the haves and the have-nots in terms of the retail sector. It's a confusing market. It's one pocked by idiosyncrasies. We're going to talk a lot about the car blip that we're probably going to see in the data that comes out in about an hour's time. How much can consumers keep spending if their disposable income keeps getting contracted by how much their bills are going up?
And not a great start to the Christmas spending period, is it? The holiday season. Cuts at Amazon. Target saying in the latter weeks of the quarter, sales and profit trends soften meaningfully. Put it all together.
There's a distinction here, John, between someone getting their Christmas tree out far too early in the beginning of the shopping season. You're right. It's the beginning of the shopping season as well. Just so you understand, it's un-American to put the tree up before the Macy's Day Parade is over.
Pause. I like to have it up at Thanksgiving. I think it's nice. I think it's nice to have the tree up for Thanksgiving.
Lisa, help me here.
I'm not going to weigh in on this. If he wants a tree, go have a tree. Have a great Merry Thanksgiving.
I think it's nice.
Merry Thanksgiving, precisely.
and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
First it was CPI downside surprise, then it was PPI downside surprise. Equities absolutely exploding higher over the last week. This morning, futures negative on the Nasdaq 100 by about 0.1%, unchanged on the S&P 500. Quick sneak peek at the bond market, 2s, 10s and 30s look like this on a 2-year yield, 435.49. The highs of the year, intraday of course, very close to 480 2 Fridays ago, after payrolls and immediate aftermath in that 10-minute window when we were pushing yields much, much higher. We've backed away since then on a 10-year as well. We peaked at around 433, 434. We're back down to about 377. Are we approaching that window when growth starts to get hit and yields start to roll over? Torsten Slock of Apollo had an interesting way of framing this. He said the sequencing is important, and the sequencing right now in the United States compared to Europe is different. That in the United States at the moment, there's evidence that inflation is peaking before growth gets hammered. And in Europe, both on the continent and in the UK, there is evidence that growth is getting hammered before inflation peaks. Let's look at foreign exchange briefly. Euro dollar, sterling. Tom, euro dollar 104.17, way off the lows of the year. Cable, lows of the year, end of September, 103.50, 119. But on that inflation story, it's problematic in Europe, we know that. In the UK it is as well. 41-year high on UK CPI.
Yeah, maybe enough to adjust the Bank of England here. The depth of that really alludes to the 2-year call of a recession by Governor Bailey. John, you're linking foreign exchange bounce into the equity market bounce. If you do a standard deviation study of Standard & Poor's 500, we were so gloomy. We were so down, down, down. This vaunted bounce just gets you back to middle of trend.
What did the bulls want, Tom? They wanted some evidence that inflation was decelerating. They've had a little bit of that. They wanted yields lower. We've had some of that. And they wanted the dollar weaker. We have had a ton of that, haven't we?
Oh, we have, and also you've had Fed adjustment in the language as well. Maybe we'll see more of that today. But I would just say we forget, John, the damage of the last 2 months.
Brutal. I agree with you. It has been brutal. Euro dollar right now, just about hugging, holding on to 104. That's the cross-asset price action. Let's get you some single names. We can do that with Lisa. Hey, Lisa.
Hey, John. We are getting some of the retail earnings, and let's parse through what we've gotten and what we expect to get. We've gotten Target. It was brutal, to use that word. Very much off the mark, down 13%. They saw sales decline. If you look at the overall, their profits decline more than 50%. They had to discount a lot of items heavily to move it off of their racks, basically the unwanted items. As you guys both were talking about, Tom and John, earlier, how much is this a story of execution? How much is this just composition? Because Walmart performed much better than expected. Yesterday, shares were up more than 6%. Today, falling about 1%, perhaps in sympathy with Target. But Walmart really gained market share in groceries, in some of the essential items that homeowners need to buy. They're doing better. Target perhaps not making as many inroads there and seeing just the overall ticket items really coming down.
That's perfect, Lisa. And what's fascinating and original is Target says no layoffs, but $3 billion of efficiencies. Does Walmart have efficiencies? I don't know.
Walmart is doing better in terms of how it has planned and in terms of its guidance going forward. Beating guidance target is not, and they're talking about a quickly moving consumer. TJ Maxx, which is a discounted retailer, may stand to benefit from some of this. They're reporting earnings within the next few hours or so. Those shares down about 1.5% in pre-market trading, but how much are they going to benefit from companies that need to offload some of their inventories and then they clear them at a discount? How much do they give a guidance as to what this holiday season is going to look like as people try to look for bargains? Are we going to get a real disappointment? We've gotten that sense from Apple already.
And there's a retail report into retail sales. Target moving the markets. We had green on the screen earlier. We're now futures -1, Dow futures -3, but nevertheless a reversal off the target shock. In the bond market, there have been many shocks. Michael Collins picks up the pieces, senior portfolio manager at PGIM, fixed income. Michael, the short answer is given vol. You ask someone like you what duration is doing. The length of maturity, I'm going to call it on average, in a bond portfolio. What are you doing with duration given the uncertainties into 2023?
Yeah, in general, Tom, we're advising our clients to extend duration here, right? I know it sounds a little counterintuitive, right? When the yield curve is really flat or even inverted, the knee-jerk instinct is to move into higher yielding short maturity bonds. But when you do that, you're actually taking on a lot of interest rate risk, because who knows what the world's going to look like in a year or two. Short-term rates could be back to 0, 1, or 2, and you'd be giving up all that yield. So the right thing to do is actually extend duration in a flat curve.
An unfair question, but then across the qualities of bonds, full faith and credit and their flavors, high yield, IG, quality corporate, lesser quality, and even into distressed bonds. Dare I even add municipal bonds? Where's the value?
Yeah, I mean, this is an easy one, Tom. It's in high quality liquid bonds. I mean, this has not been a credit-driven sell-off. This has been an interest rate and liquidity-driven sell-off. So interest rates have jumped. The most liquid, higher quality bonds have actually underperformed lower quality bonds on a risk-adjusted basis, and in some cases on an absolute basis. For example, old-fashioned agency mortgage-backed securities and high-quality debt of U.S. investment-grade corporations, and even those municipal bonds you mentioned have actually been some of the worst performers. They've been hit by interest rates and a lot of forced selling from UK pension plans to US mutual fund managers. So that's where the value is. Right now, you're not getting paid enough incremental yield to go down in quality, especially given what you guys are talking about this morning, the slowing economic activity.
We're just getting some headlines. We've been getting earnings all day from retailers, and TJ Maxx putting out their earnings that beat estimates pretty much across the board, although their home goods comparative sales were down more than expected. Michael, how much do you have to really parse through these earnings to understand which companies can survive, which companies can withstand a capital structure that was built in a very different interest rate structure?
Yeah, oh, absolutely. That is so critical at this, when you get these turning points in the economy, Lisa, looking at the underlying companies, the ones that can handle the inventory situation, the ones that are seeing more demand from consumers as they trade down, right? I know my wife and daughter went to TJ Maxx the other day to go shopping, right? And not that they necessarily have to trade down, but that's where the value is, and that's where consumers are going. So you're seeing that broadly across the economy, and it's going to benefit certain businesses, certain companies, and hurt others. So that's where the bottom-up research really comes in handy.
In the meantime, we're looking at an index level. You talk about an investment-grade credit and how much you liked it. It's lost about 16% year-to-date, including the 5% rally that you've seen since late October 20th. I was looking at this morning. I mean, everyone's been saying go into U.S. investment-grade credit. Well, they have. Could you see some sort of rebound akin to the declines that we saw this year? In other words, a double-digit returns type of year for some of this plain vanilla, low-coupon yielding asset?
Yeah, absolutely. There's a scenario you can paint, Lisa, that will put you in pretty good position in the next 1, 2, 3 years. I mean, the yields on high quality bonds, and it's not just investment grade credit. Some of it is high quality asset-backed securities, and like I said, munis and other things. I mean, some of these yields are in the 6s and 7s, all right, in a static interest rate environment. And again, in a year from now, we might be in a world, Lisa, where inflation is not 5 anymore or 4. Maybe it's 3, which is our base case, but who knows? Maybe it is 2. I mean, you're looking at year-over-year food prices are back to 0. Right? And that's what happens when you get these elevated prices on everything. The year-over-year numbers start to go towards 0 and maybe even turn negative. You could have a funds rate at 2. You could have a 10-year treasury at 2. So you could have high single-digit returns in relatively short order in some of these high-quality bonds.
Mike, I just want to understand this, and Tom and I have talked about this a few times. There's someone out there holding an Austrian century bond, and they've been hammered on price.
Thank you.
What do they do with it, Mike? Because you don't sit on it and wait for it to mature. You're not going to be around for that. So, Mike, I just wonder what they do with it. Do they just let it sit there on the balance sheet? Do they sell it? Do they take the losses? What do they do with that stuff?
Yeah, you typically don't sell it, right? When you get those margin calls like we saw in the UK, LDI pension plans, you don't sell a bond at 40 cents on the dollar or a junk bond at 50 cents on the dollar. You sell the highest quality, most liquid, AAA rated, CLOs at 98 cents on the dollar, which pushes them down. That's how it works. And that's exactly what's happened this year. That's why the most liquid, higher quality bonds have actually underperformed.
Mike Collins of PGIM. Great stuff as always. TK, you've talked about it all year. The price losses in some of this debt.
Oh, I'm still seeing it. John, I feel very strongly about this. Retail's getting absolutely hammered, and I would suggest institutional seeing yield up, price down as well. We go into all this Frank Fabozzi mumbo jumbo, and you know what? It doesn't work.
Is that what you're calling it? But
it's
Fabozzi mumbo jumbo.
Fabozzi mumbo jumbo. Forget about it. It's real simple. Somebody's hammered down 8%, down 12. Lisa, help me here. On a general bond portfolio, down 15%. Is that close?
16% for U.S. investment grade bonds so far this year, including a 5% rally since October 20th.
We talk about equities where you recover, you buy quality, you reallocate, you take a tax loss. What do you do in bonds? I mean, I don't know. John, I love TJX, and this goes to what Lisa, I thought you were brilliant, Lisa, on Walmart, Target, there in your equity report. TJX, which I think some people don't know, it's a unique store out of Boston. They're looking, John, that after you put the tree up before Thanksgiving, they want you to look at a, quote, fresh, enticing, gift-giving assortment. There's some nice optimism within Ernie Herman's comments here at TJX.
Have you ever been to a TJX?
I was there once.
Have you ever been to a TJX?
It was before the Red Sox first won.
I don't.
Plenty.
Of course, we both have. I just don't believe that
they sell great Hermes bow ties.
There's one on First Avenue, if you're interested. I think it's on like 58th, something like that, if you want to pop.
Thank you.
You should just sample it. There's a Home Depot you've never been to, downstairs below the building too.
I've been to that one too.
Still haven't got you there either.
To get screws.
I went there once. Vetville wanted an aluminum Christmas tree with a light thing going on the bottom.
In the store?
Yeah.
Nice.
Is that our shopping segment
That's
that we just
it.
did?
That's our shopping
that was brilliant.
Vetville
Being on a tree. Oh boy.
Ideas. Vet, be good.
Marvin Lowe's coming. Senior Global Market Strategist at State Street. Does your dog watch this?
Yeah.
Or listen to it? Do you leave the radio on or the TV on?
No, the TV. We do both. But
you
TV.
Do both?
Yeah.
Okay.
We do both.
So the dogs hear you all morning.
Yeah.
Surveillance for your dogs.
Are they called by their real names or by? Is it still
when
Vetville?
I'm on the
when
street,
you speak to them, you say
when we're
Vetville.
out in public, people will come up and say, "Oh my God, is this Vetville or Kennel Fee?" And they're vet or kennel, you know.
Nice.
Yeah, got a puppy cut yesterday. Inflation.
Well, we'll talk about that price in a moment.
Killing me.
People can't wait. That's the tease. From New York, this is Bloomberg.
We have all kinds of viewers, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, NATO says that the explosion in Poland was likely due to Ukrainian air defenses. The blast killed 2 people in a Polish village several miles from the Ukrainian border. The Secretary General of NATO, Jens Stoltenberg, says the blast was probably caused by a Ukrainian missile fired to defend against Russian cruise missile attacks. Members Club Soho House is getting a new CEO. Founder Nick Jones will hand over the day-to-day operations of parent company Membership Collective Group to current president Andrew Carney following a recent diagnosis and successful recovery from prostate cancer. He'll stay in a founder role focused on designing new houses. The company announced earnings that showed revenue climbing 48%, but reduced earnings guidance to reflect costs and currency headwinds.
I'm going to be doing all the things that the reason why we set Soho House up in the first place. You know, creating great spaces, spending more time with our teams, spending more time on member experience, and also with our members. So I'm really going back to what I always came into this business to do in the first place, and I love doing that.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Consumers now are dramatically shifting what they're purchasing and how much they're purchasing.
So many businesses like the Targets, like the Walgreens, are sitting on inventories that are maybe less desirable for consumers right now. And so some goods are going to see some downward price pressure as businesses try to eat through that existing stockpile.
Target does not impress. That stock is down by almost 14% in the pre-market. That was Lindsay Piegza of Stifel. Right now from New York City, let's take a sneak peek of this market going into the opening bell. 1 hour and 42 minutes away. Equity futures unchanged on the S&P 500. Yields going nowhere. 376.21 on the US 10-year. And in foreign exchange, the euro strength, dollar weakness, Tom, resumes. Euro dollar 104.13.
It's a nudgy day, and I think we're waiting for retail sales here in 45 minutes. That's all there is to it.
That's the next stop for this market, without a doubt.
No question on that. Again, we're watching what's going on in Poland. Maria Tadeo in Brussels this morning. In retail, and I think Lisa's been brilliant on this morning, the differential between Walmart and Target, it is always about culture. In luxury, it may be LVMH and Hermes. Take it all the way down to the dollar stores. Culture of managements and company matters. Jennifer Bartashis is expert at this with decades of work in packaged food and retail sales analysis at Bloomberg Intelligence. Boy, it matters, Jennifer. It's about the culture of a company. Which culture in retail is going to win over the next year?
Well, in this environment, it's really about the flight to value. And so the retailers that are in that value proposition, and we saw Walmart yesterday, are resonating with customers. But this is the inherent danger of Target's core proposition. You know, people love the decor, they love the apparel, they love kids' items, but those just aren't in demand right now.
Can price clear inventory?
If you go low enough, it can, but that's what we're seeing when it comes through to the margins for Target. I mean, they actually made a comment that people are more reticent to buy anything that's not on sale, and so yeah, you can get rid of it, but it really comes down to how badly that's going to affect your results.
Tom, you've been talking about this for a long time. You go into the grocery store and everything's on sale, and if it's not on sale, it doesn't go.
Yeah, I mentioned Carbone's a great restaurant and their spaghetti sauce yesterday, but you can take that across everything.
I love this. I love this. Wait, pause. Stop. Do you know what Budget is for TK?
Yes.
Budget is an Italian restaurant in New York that just lost its Michelin star this year. That's Budget for you.
I know. It's ridiculous.
That's like if it doesn't have a star anymore, it's a step
Carbone was in
down.
the store.
This is the step
I said
down
I haven't
Tom
been below
Keane.
59th Street in like 5 years.
I'm going home. That's it.
Pick it up with Jen Bartashis.
Jennifer Bartashis, please save us. Is this an execution issue, or is this something deeper that has to do with the consumer, right? I mean, you talk about people not wanting to buy something that's, unless it's discounted. Is that simply an oversupply of goods and marking up too quickly, or is this something more profound that speaks to a consumer that's really flat on its back?
Well, I think it's a combination of the two, to be honest. First, we had an oversupply of inventory that came because people were worried about the supply chain issues last year, and people brought inventory in early this year to make sure they'd have enough for holiday. So even though there were a lot of markdowns early in the year, there's still a lot of inventory out there. And at the same time, you have customers who are becoming increasingly budget conscious and are really only seeking value. And that's just a very bad mismatch for a company like Target right now.
Jennifer, what do you make of the online presence? Everyone hailed this as the next coming for a lot of these companies to compete with Amazon. And you're seeing those areas underperform possibly more than any other. What do you make of that?
Well, you know, I think when you're online, it's more of a mission type of online shopping experience. It's still not a great thing to just browse and try to find something. And so right now, people are looking for value and they're looking for inspiration. So that is where we're starting to see a little bit of a shift back into stores. We saw positive traffic at Walmart. We saw it again at Target, where people can go and they can browse the racks. It's much easier in person than in a virtual environment. And online, you know, it's a little harder to just execute on that and to do it well. It will be important in holiday, especially with Black Friday and Cyber Monday coming up. But I think that's going to be a little spike that we'll see on the e-commerce side.
Jennifer, the stunning headline, and I want you to take this beyond Target. The stunning headline is they're going to have efficiencies without job cuts. I've never heard of that. What does that mean? Translate that.
So really, I think what we're talking about is finding ways to optimize their productivity. And so that means really taking a hard
Jennifer,
look.
Stop it. You sound like a McKinsey consultant here. Translate that for mere mortals.
Okay, so for the average person out there, what this means is they're not going to cut jobs, but they're going to try to find cheaper ways to do things. They're going to try to find cheaper sourcing. They're going to try to reallocate labor so that you might not have as many people on the floor in the store, and it saves on labor hours, but without sacrificing jobs. So those are the kinds of things that they'll probably be looking to do. And just to try to make sure trucks are full, simple things that can ultimately cut costs and make it cheaper to run the company. But right now, it's hard to envision how they'll do that without a round of layoffs that we've seen at other companies. We've heard about it at Amazon. We've heard about it at Walmart. We'll have to see if they can actually do it.
It's early days, although John is preparing to put up his Christmas tree already. So I am wondering if we have any early view on what to expect from the holiday season.
Yeah, it's a good question. We actually look at Bloomberg second measure transaction data, and one of the things that we saw was that for October, when a lot of these companies were running early promotions, early Black Friday deals, that the sales are coming in at the low end of what the industry is forecasting for the holiday season. Now, that may tick up a little bit in November, but so far the transactions have been a little bit weaker and really indicate that it will be a challenging season for a lot of retailers.
Jennifer, wonderful to hear from you today. Thank you. Jennifer Bartashus there of Bloomberg Intelligence. You guys have a go at me every November for the same thing. I think it's fine.
No,
I'm not alone. I know that people do it at home too.
It's joyful.
What's the big autumnal dinner in England? Is there like a Thanksgiving equivalent?
No, there's not.
No, I'm serious. Is there like some big celebration?
Sometimes you kill me. Do you know what I'd love to see from you? I was just thinking about this as that conversation was ongoing.
I'm cooking.
If you could do something like the late great Bourdain, like Bourdain with a bow tie, and you could go around New York restaurants and bars, Tom, I'd watch that. I think that would be gold.
Trying to get him to change jobs.
No, this is a special, like a 5-part series, something like that.
John, I'm cooking for Thanksgiving.
I know, I've had some of you cooking
Alan's coming over. I'm going to Benoit. I mean, they do a one. It's casual.
Are you cooking for Benoit
price.
or?
No.
Whoa, pause. Benoit is casual?
Is
that what you're saying?
Slumming it with
I mean, this is ridiculous.
We're going to call it slumming it with Tom, okay? Because slumming it with Tom in New York is a very different experience. It's a very different experience.
But let's cut to the chase here, folks. On Thanksgiving, we're starting our holiday team coverage here. John, Lions and Bills, or do you watch Portugal and Ghana?
I think you've just answered your own question, haven't you?
I mean,
that was.
But also, it's not.
World Cup's on at the same time?
It's Brazil on Thanksgiving.
Oh, Brazil's on at Thanksgiving? I didn't even know that.
Brazil's on Thanksgiving. And then doesn't England play the
Brazil's
United States on
Packers.
Friday? They're playing the Detroit Lions. That's right. That's how this is going to work
How's
out.
The end zone
Thanksgiving.
For the World Cup.
My goodness.
Is there an end zone in Qatar?
There's an end zone in Qatar, yeah.
Seriously?
They've put one in
And
just
there's
to
some real
attract a
cultural
bigger
issues
American
here.
audience. Yeah. They've put an end zone
Do you
in.
wish you were there? I don't know why you're not.
He was
put in a
not
vote
here. That we could all agree on. He does not want
You
to
want
be
to
here
vote to send me to Qatar?
Seriously, you'd be encyclopedic.
Okay.
It'd be really good.
So Tom is trying to send John to Qatar.
You're on your own.
And John is trying to send Tom
You're flying
around
solo.
the city.
The 8 a.m. Bramo solo. It's what you've always wanted anyway.
It's true.
No.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a, started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Right now, it is about the Fed.
The Fed wants to slow down its pace. I don't think the Fed wants to get as high as it needs to. And I think the Fed's also hoping that they see inflation come down.
The good news is there's a distinct possibility we'll see inflation moderate fairly quickly.
There's still a lot of money out there sloshing about, looking for where to invest.
2023 is likely to be a stock picker's paradise.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on a Retail Wednesday at 8 o'clock. We are 30 minutes away from retail sales. And John, on the ECO screen, I see 17 lines of economic data today. It's not just about retail sales.
It's not, and you've got to put it all together, and so far, so good. Downside surprise on CPI, downside surprise on PPI. So inflation rolling over. Can growth hold up? This is about a window of resilience, Tom. How long before growth starts to crack? Retail sales very much in focus when it comes to that.
And a global story and stunning news out of England. I want to say it's discreet to England. Maybe it's discreet to the Netherlands. But those inflation numbers in the United Kingdom crush the consumer.
It's a European problem, not just the UK. It's a European problem. But the latest figures out of the UK, 41-year high. And the fear is, to go back to what Torsten Slock over at Apollo is talking about, the fear in the UK and Europe for that matter as well, is that basically what you're seeing is growth get hit before inflation peaks. That's an argument you can't make in America right now. People are already saying we've seen peak year-over-year CPI in America. You cannot say the same thing just now for the UK and for the whole of the continent.
One of our guests talking about food CPI coming down, that disinflationary trend people like David Rosenberg are talking about. But Lisa, it's really company to company within the aggregate retail sales control group. We're going to see at 8:30. You pointed that out with Walmart and with Target.
Yeah, how much do you see a real dispersion, but how much does it paint a picture of consumers looking for some sort of discount, some sort of way to potentially manage through a holiday season? I'm a little bit distracted because the news is moving so fast, and this headline, I'm just keep looking at it, this potential for Genesis suspending withdrawals and originations in their lending business, Tom. And I bring this up, I will get more details, I don't have them right now, but there is this question of what's the next shoe to drop in markets, right? Is there a sense that there is something going on? And I do wonder if that's sort of under underpinning this fear that people have to become fully invested at a time when things are less bad than they were expected
In
to be.
Amy Wu Silverman, moments ago, guys, maybe get up that video for us later in this hour, John. Amy Wu Silverman correlating Bitcoin and its struggles directly over to markets. Now, Bitcoin at 16,600 on an intraday basis on the Genesis News comes down an immediate $150. We'll see if it finds intraday support. This is removed, John, but it's not.
I need to be super accurate about this, so I'll go through the story that we've got here at Bloomberg piece by piece. The lead paragraph, crypto brokerage Genesis is suspending redemptions and new loan originations at its lending business after facing what it described as, quote, abnormal withdrawal requests in the aftermath of the collapse of FTX. The story goes on to read, the withdrawal request exceeded current liquidity at Genesis Global Capital, the lending arm, according to the interim CEO. Genesis has hired advisors to explore all possible options, including raising new funding, and will deliver a plan for its lending business next week. The move will affect only the lending business, Tom, according to the interim CEO, who said Genesis spot and derivatives trading and custody business, quote, remain fully operational. So, Tika, we've talked about these cascading issues through this universe, and here's another one.
Well, the cascading issues are there, and it has to do with SEC, CFTC. ETFs are almost ETFs trading at substantial discounts, which model Bitcoin way under the 16,000 level. But I agree with you, we have to go through careful reporting paragraph by paragraph. I should point out Mr. Silbert in our reporting putting up $140 million equity infusion doing that last week. So Genesis, I'm going to suggest it's not what we've seen from FTX, but there it is nevertheless linked, sequentially linked to it.
We'll take some time to build this story out. I'll just touch base on the markets for you just briefly on the S&P 500. Unchanged, futures unchanged, 25 minutes or so away from retail sales in America. Equities, though, quite the lift over the last week. You've all witnessed that in this market. In the bond market, yields basically unchanged on a 10-year, Tom, almost down a basis point at 376. On a 2-year, let's call it 435. We're up about a basis point this morning.
Let's do this. We'll continue to monitor the Genesis story and what it does to Bitcoin, now 16,500, down 2%, with Marvin Lowe, senior global macro strategist at State Street. Marvin, the retail picture, the consumption picture makes up 70% of the economy. How does the new tepid retail environment change an American strategy at State Street?
I mean, it's part of the evolution ultimately. You know, we're all certainly trying to figure out when the point is correct for the Fed to slow down, when the tightening is going to slow down. And it really does come back to a middle-class driven inflation at this point. All the savings, all the wealth that was created over the last couple of years has kept spending strong. And, you know, we're seeing supply chains ultimately start to right-size, if you will. But really, there's still savings out there. So, you know, really trying to get a sense of, is the environment changing to a point where this kind of middle class, which has pent-up savings, is starting to slow down a little bit. And we've started to see signs of it. Certainly the bottom end was affected first. It's bled into the middle class, but it really is a function of how much of that wealth is still out there and how willing people are willing to spend it.
Resilience, Marvin. This is the debate of the moment, the lag between making a decision on policy and the time it takes to hit the economy. Now, Marvin, at the moment, there are people who are confident, at least they're hopeful, dreaming perhaps, that inflation is rolling over and growth is holding up. How big do you think that window actually is?
I think it's really small. I think it's really small. You know, the transmission mechanism certainly is something that everyone's focused on. When we kind of think about when rates were really low, the broader economy or the average American didn't benefit as much. As we raise rates, it's understandable that it's taking a while for those interest rates to make its way into the broader economy. I think it is a narrow window because of that transmission mechanism where the Fed ultimately needs to go very aggressively, as they have already, to just start to get a crack in the real economy.
We talk about resilience in the consumer. What about resilience in markets? And we see an ongoing barrage of information, and we have seen some significant losses. People have talked about liquidity issues in the treasury market, but it has not been a market fissure. It has been nothing that really has caused market dysfunction akin to what we've seen in the past that has caused policymakers to step in. How close are we to some sort of financial accident based on liquidity and based on some of the risks out there?
You know what? It's interesting. The Fed and Treasury are certainly taking up this Treasury kind of liquidity issue to the forefront. There's a big report out there from the New York Fed at this point. I actually think that the market is handling the volatility fairly well. You do expect wider bid-offer spreads, if you will, kind of in our world, when you get this kind of uncertainty, when you get this type of volatility. So, I think that the risk always increases as we get more volatility in the market and we get further along in this tightening process. But I actually think it's functioning fairly well.
The Target CEO on the earnings call right now, with a couple of big headlines, I have to say, planning for, quote, rapidly softening demand, saying that borrowing options for customers are running out. And Marvin, I think this speaks to what you're talking about at the moment. So Marvin, here's the question. Of everything that's rallied in the equity market right now, what would you fade based on some of this? And also, can you tell me whether you think the bond market's going to rally when we start to see this softer economic data?
I'll answer the latter first because I sit kind of in the fixed income world first and foremost. I do think that we're going to rally in the bond market. I think fixed income at this point as an investment kind of within your asset allocation thought process is an easier type of play. On the equity side of things, everything rallied. I do still think defensive growth, however you want to define that, is something that you want. I think energy, because supply issues remain one of those issues. Everything else, retail, I think is a struggle when you kind of get this buoyant market that is a tide that's lifting everything. In a period of still, fairly wide uncertainty, you have to pick which ones you like.
Marvin, wonderful to hear from you, sir.
Marvin, thank you.
As always, Marvin Lover, State Street there. Target in the pre-market down by more than 14%. Just to go back over those headlines, Target's CEO on the earnings call right now, planning for what he calls rapidly softening demand, Tom, saying that borrowing options for customers are running out.
There's no question about it. And what I would suggest is this is immediate. This is the tone I'm getting. Correct me if I'm wrong. Is this happened in weeks? This is not quickly. Something that we knew early October.
Yeah, and that's not just our interpretation. We were told that in the earnings release, in the statement, Lisa, he's talking about the speed, the weakness that came through at the back end of the quarter, and clearly bleeding into the end of the year too.
Yeah, how much do we continue to see this? I got to bring up one other point that really stands out to me, with the Target CEO saying that the company is seeing an increase in theft and organized crime. And I don't know if you guys have been into a Rite Aid or a Walmart or any of these stores. They all have gated up home goods, whether it's shampoo and conditioner, et cetera, because of the organized crime. How does that really affect earnings? I've been wondering this with Rite Aid in particular.
The standard's 2% or maybe outrageously 4%. And I think many of these other companies are way above that number right now.
But this really speaks to the social fabric right now that a lot of people have been talking about, the sort of theft and the companies that are dealing with it.
Can I give you a paragraph here, like a Katie Greifeld paragraph on Bitcoin holding it? From the Genesis website, quote, lend over 25 digital assets, stable coins, and other fiat currencies to Genesis. Increase capital efficiency, earn yields up to 10%. That encapsulates everything we're talking about here. I'll tell you, folks, Katie Greifeld, I couldn't tie her shoes on this. And the answer is that one paragraph encapsulates the hope that seems to be drifting away.
The latest headline just moments ago, Genesis suspending withdrawals on its lending arm, in a fresh blow to crypto. That's our lead story right now. We'll pick up on that in just a moment. We're going to catch up with Greg Valliere of AGF Investments too. Quite a story down in Florida, Tom. The former president announces he's making a run, and the Blackstone chief himself comes out and tells Axios, no thank you, not supporting that one.
No comment from the governor of Florida on that.
I wonder if that's the man he's going to be supporting, Tom. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The leaders of NATO and Poland say there's no indication a missile that struck Polish territory was an intentional Russian attack. The blast killed 2 people in a village a few miles from the border with Ukraine. NATO says it's likely the explosion was caused by Ukrainian air defense missile fired against Russian cruise missiles. Donald Trump says in order to make America great and glorious again, he's going to make his 3rd run for the White House. The former president made it official Tuesday night in an event at his Mar-a-Lago resort in Florida. Meanwhile, mega donor Steven Schwartzman, the billionaire chairman of Blackstone, tells Axios it's time for Republicans to turn to a new generation of leaders, and he won't be supporting the former president at this time. More fallout from the implosion of crypto firm FTX. Another brokerage, Genesis, is suspending redemptions and new loan originations at its lending business. Now that's after facing what it calls abnormal withdrawal requests following FTX's collapse. The withdrawal requests exceeded current liquidity at Genesis Capital, the lending unit. Meanwhile, Standard Chartered CEO Bill Winter says it's clear that the industry faces more regulation.
What's going to happen? All of that stuff, that ecosystem, is going to come into the regulated institutional environment because it's just too risky to sit out with a bunch of cowboys who have managed to blow themselves up.
Winter spoke at the Bloomberg New Economy Forum in Singapore. And shares of Target are plunging. The retailer warned in its latest earnings report that American shoppers are pulling back, and that slammed Target's profit. And it prompted the company to cut its outlook. Target's also looking for $3 billion in cost cuts. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
In order to make America great and glorious again, I am tonight announcing my candidacy for President of the United States. This is a movement. This is not for any one individual. This is a job for tens of millions of proud people working together from all across the land.
The former President Donald Trump making it official yesterday evening down in Florida. Making it official as well, Stephen Schwarzman of Blackstone to Axios with a statement. In the last couple of hours, America does better when its leaders are rooted in today and tomorrow, Tom, not today and yesterday. It is time for the Republican Party to turn to a new generation of leaders, and I intend to support one of them in the presidential primaries. And that one, Tom, will not be the former president.
No, there's no question about that. We saw that from Mr. Griffin in his conversation with Bloomberg yesterday, and frankly, with others as well. I got to slip this in. The news flow this morning, folks, is just extraordinary. Stay with us for that retail sales in 12 minutes. Joe Feldman, who is a kind guy, a gentleman, crushes Target in his pre-press conference research note. Operating margins down 400 basis points. He doesn't mince words.
Execution or environment or both? Which one is it?
It's both, but you get the illusion from Joe before the press conference. Execution, let's go, go, go.
Rapidly softening demand, the line from the CEO.
We'll get that.
Not what you want to hear.
And retail sales again in 11 minutes. We'll go bigger, broader here at 8:30. Right now, bigger and broader on the politics of the moment. Gregory Valliere joins us from his Canada with AGF Investments of Toronto. We're thrilled we could get his perspective this morning. Greg, I want to use your words, which is you take off on sleepy Joe Biden and suggest you saw last night sleepy Donald Trump. Expand on that.
Well, first of all, Tom, I thought that Trump last night was boring. I never thought I would use that word associated with Trump. I kept wondering if somebody was going to give him a double espresso. I mean, he didn't show a lot of energy. He seemed very, very subdued. And if that's the best he's got right now, I think a lot of Republicans are going to think about jumping in, not just Ron DeSantis. I think people like Youngkin, Nikki Haley, I think a lot of Republicans are going to see what's happened in the last few days and decide they're going to run.
The pushback is Mr. Trump has the voters that voted for him before. Explain to our international audience the Republican Party process pre-primary. Who has the upper hand?
Well, you're probably going to have 8 or 10 candidates running. So whoever wins, say, New Hampshire could have 32% and win New Hampshire. So in a big crowd, Trump still has his base. But I would argue that the defections away from Trump in the last few days have been extraordinary.
On a more immediate level, Mitch McConnell, will he retain his leadership position over the Senate?
Absolutely. I don't think it's going to be close. I think that Kevin McCarthy is still in some trouble when they have to vote again in January. I think he's on very thin ice, but McConnell is in good shape.
So on the flip side, does this actually put the Democrats in a strong position, or does this just mean that they're in a less vulnerable position for now, but still gridlock in Washington?
Still pretty much gridlock in Washington, and I've got to say, Lisa, that's a fine story for the markets. The markets can live with this because any progressive legislation that makes it out of the Senate and goes to the House will die in the House.
Greg, tell me about the Democrats here. The Senate Majority Leader, Mr. Schumer, reached out yesterday to Republicans. I thought that was fascinating. Is there any hope of a middle ground given the upset that Republicans faced last Tuesday?
Not much. You know, maybe it was Susan Collins of Maine or Mitt Romney of Utah, but I don't think there's going to be a lot.
Right.
But by the way, in the next month, there's going to be an enormous amount of work on spending. They got to get a budget done. They got to get money for Ukraine. They're talking about some tax breaks for business and individuals. This bill is going to come out like on Christmas Eve will be huge in terms of spending.
Well, I'll say that we'll be working on Christmas Eve if you keep that up, Greg. Greg, I want to talk about the changes in Washington. Is it gridlock as you see it, or is there a new character to the gridlock that we see in 2023?
I think it's still gridlock in 2023. I've been through the kumbaya stage for decades, and it doesn't usually pan out. There are some very interesting issues, and there might be some grounds for a compromise or two, but you know, I just don't see any kind of big breakthrough on that front.
A big theme of 2022 is the lack of fiscal impulse, the fiscal response to a downturn that a lot of people see as increasingly likely. Do you think that the outcome of the midterms changed that scenario at all? Do you think that there's a little bit more openness to possibly being more targeted in where they deploy money going forward in the case of a downturn?
Well, they're going to spend money like drunken sailors between now and the end of the year to get all their budget stuff done. It's going to be a pig out in both houses. But as we go into next year, I do think there will be some restraint on spending, except for defense. Considering all the stuff that's going on around the world today, I think defense spending gets a big boost.
Greg, awesome. We need to talk to Greg more, don't we? Don't you agree?
Oh, he's great.
He's just fantastic. Greg Valier of AGF. Greg, thank you, sir.
I think the whole host of people we have with some real nuances of their politics and their political economics, which is his specialty, is great as well. Inflation Watch, we were talking about fish and chips earlier. John, Houston, Texas, next April. Taylor, it's not James Taylor.
Okay, is this real?
Yeah, Taylor. This is from Michael McKee.
These are real prices.
McKee on the Inflation Watch. Taylor, one seat, Section H, row 9, $34,611.
They're not. Seriously.
It's a new Eras tour. The Eras tour.
That is ridiculous. Did you see Congresswoman Ocasio-Cortez, what she had to say? Daily reminder that Ticketmaster is a monopoly. Its merger with Live Nation should never have been approved.
Your politicians at work
and they need to be reined in, break them up.
Well,
we had Ron Clayton weigh in as well.
This is not James Taylor. This is Taylor.
Thank you for confirming, Tom. I needed that. That was important.
That was important.
I don't believe these prices. Are they real prices?
I'm looking right now at a story in The Guardian that was talking about that prices were listed as much as $22,000 with Ticketmaster as it crashes. Yep, that's right. And that basically it quotes people saying, "I'm a failure as a father." As they start talking about
so sad. Are you serious?
Buying Taylor Swift
Someone said
tickets.
That. They feel like that's beyond sad.
I'm sorry. I mean, it takes more than that to be a good dad.
That's
you know, what bothers me is she announced this, John.
Not just buy Taylor Swift tickets
Miss
for
Swift
$20,000.
announced this on Good Morning America. I don't know why she can't announce this on Bloomberg Surveillance.
Oh, you think the exclusive should have been for her?
Come on.
You know.
There's a bigger point here. Can we talk about
What's
the bigger point?
than the point he just made?
Clearly.
I challenge you.
Okay, I will deliver on that challenge. People are going back to live events in mass, and this is an entire industry. Experience is still seeing inflation because people are going back, and they are going back in mass. I'm not saying $22,000 as an example of a CPI bucket item, but
guys,
I'm not going to get
afterthoug's going to hit me up and go, Dad, I don't care about Taylor Swift. She's going to go, Paramore's opening for Taylor Swift, and she wants to see Paramore.
That's the opening act.
It's one of them.
You're going to feel like a failure as a father.
I am a failure if I can't pop
$22,000. Your discount for Carbone, maybe you'll get it for $15,000.
Yeah.
The smallest violin ever playing in the corner of this studio.
Yeah, it's like a harmonica.
Coming up, retail sales, and then breaking down retail sales. Mike McKee. We'll talk about that a little bit more, I'm sure, with him. Kathy Bosjanski is going to join us, chief economist at Nationwide.
Double barrel, BTS and Taylor.
How much would that cost?
That would be $50,000. You know,
I thought you meant
ridiculous.
Surveillance.
Nuts.
Who's BTS?
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Next up for this market, retail sales in America. Equity futures right now down 0.1% on the S&P 500. Yields higher at the front end of the curve on a 2-year, 435 on a 10-year. Yields there up a couple of basis points too. With the data, here's Mike McKee.
Well, it looks like Americans are still spending money. We don't know how much of it is additional because of inflation, but retail sales come in at 1.3% for the month of October. That's better than the flat number we got in the month of September, and better than the 1% anticipated. Take away cars, and it's still 1.3%. Take away cars and gas, and it's 0.9%. It's the retail control group that we really watch because it strips out the stuff that goes into GDP in other categories. This is what the consumer spending number looks like, up 0.7% for the month of October in the preliminary reading here, and that is better than the 0.6 revised number for September and double what the 0.3 anticipated was. Looking at the import price numbers, import prices fall 0.2%. Ex-petroleum also down 0.2%. So you got two things going on here. One is inflation because of imported goods is going down, maybe a residue of the strong dollar, and may also be the fact that inflation has peaked, and consumer spending is still holding up very strongly at this point.
Upside surprise, Mike. Equities down just a little bit on the S&P 500. We're negative 0.25%. And yields up just a little bit, Tom. Yields high by 5 basis points to the front end on a 2-year to, let's call it, 4.39.
It's the dynamics of the market, and John, it is extraordinary. Good morning, Priya Misra and others, of the further inversion and now out negative 60 basis points of retail sales. That's a vector, and that is sobering. And Ira Jersey, with a history of this for Bloomberg Intelligence, it is highly unusual.
Mike, how does the Fed read this one?
It's going to be kind of a dilemma for them, and I find it very interesting, and I'm going to talk about more on your show later.
You won't talk with us, but you'll talk to him later?
Well, I'll give you a tease.
Okay,
See, that's what we do here, is we tease ahead. It's interesting, Esther George from the Kansas City Fed says we have to have pain in the labor market or we're not going to get inflation down, and yet you get Target coming out today and saying, we're going to do $3 billion worth of restructuring, but we're not going to lay anybody off. So, how does the Fed deal with all of this? They have a very strong economy. You can make the case, all right, maybe we get the soft landing.
Right.
Then you look at Bill Dudley's piece today on the Bloomberg, and he says a recession's inevitable. So it's really hard to know what's going to happen going forward.
I've asked this too many times before, but it bears repeating. Is Amazon and the boxes we get, are they in these retail sales statistics?
They are in a very general sense. Non-store retailers were up 1.2%. That's better than the previous month, but that includes everything, not just Amazon, but all kinds of people who do business online, and it also includes people who go to door to door. The Fuller Brush Man would be in there. Interestingly, food services and drinking places, which is the only services category in here, up 1.6%. Tom helping out there. Clothing stores flat, no change in clothing. Gasoline stations up 4.1%, and you had to figure that because gas prices were up. But grocery stores up 1.4%. Food up 1.4%. So some decent strength there. The only real decline was in electronics and appliance stores, down 0.3, maybe connected to the slowdown in housing, or it could be just noise.
Resilience.
But overall,
it's a big thing for us, Mike.
Very resilient consumers still spending.
Equity futures, Tom, down just a nudge, a little bit. I wouldn't make too much of this. We're down a tenth of 1% on the S&P for now. Yields higher at the front end by 4 basis points.
Negative 60 basis points, 0.6 of a percentage point. That 2-year elevated versus the 10-year. That's an extraordinary number looking back 30 years. Right now, Mike McKee, thank you so much. The VIX 24.4. See, right now, Kathleen Bisacek joins us, chief economist at Nationwide. Kathy, are we disinflating as a nation? When you sum everything together, can you say disinflation is upon us?
Morning, Tom. Good to talk to you. Well, we're seeing some signs in the goods market, and certainly with the import price data this morning, you're seeing signs of disinflation, which is very welcomed. A little bit late. I think many of us were calling for the disinflation in the goods sector to come earlier. Certainly not seeing that yet in the service sector, and that's really the problem, right? Goods prices running year on year 5%, but services running closer to 7%.
Do you think that the resiliency that we continue to see in the consumer puts Fed credibility at risk?
Well, I'm not sure about the credibility, but it certainly is going to test them. As you discussed, this is a complicated number in a sense. It's great that on one hand, the consumer is so resilient. I mean, I'm looking at these numbers. The retail control, which feeds directly into GDP, so the core reading, not only was strong this month, but we had 2 upward revisions to the prior 2 months. So it really paints a much stronger picture and more momentum coming into fourth quarter. So the question is, how does the Fed really slow things down enough to allow inflation? Now, maybe to some degree, that soft landing, the coveted soft landing, maybe it will happen. Maybe we have the disinflationary forces. The Fed just needs to sit back and watch it. But it begs to, I think, the imagination to think that we are going to just see inflation, especially services, come down without the Fed being more engineering more restraint.
Well, but other people would push back, and they would say this is backward looking, and backward looks a lot better than forward. And when we look forward, we hear Target CEO saying things are shifting really quickly, and it does not look good. How do you pair the two messages from the on-the-ground immediacy of the near future versus the past that was a lot more about resiliency?
It's a great point, and I guess it's just I had expected some of that to show up in the October data. Now, maybe it will come more in the holiday season. Maybe it's, November, December, and even into January. And I think that is still a possibility. It's, but the key is the labor market has to slow. I think what you're seeing is aggregate income, which is generated by the number of people working, and wage gains is still quite strong in nominal terms, right? And you're getting some erosion from higher interest rates and inflation. But as long as you have a job, people feel comfortable tapping into their savings. That will change if someone in the household loses the job.
Kathleen, help me here. And that retail sales that we saw a moment ago is a top-line inflation reality number. If we are moving into some form of disinflation, is retail sales of use looking back 30 days, 60 days, 90 days?
Well, certainly how inflation plays out is going to have a big impact here, because you can imagine if nominal sales maintain a resilient pace, when you adjust for lower inflation, it's actually going to make the real numbers look better. So, right now, these numbers are inflated a bit by inflation. If you deflate it, it doesn't look quite as rosy, but still stronger than expected. But yeah, the key will be watching the mix of nominal and inflation. And if we get disinflation, that does actually boost real consumer spending and real GDP.
So, Kathy, Neil Dutta over at Renaissance Macro put out a tongue-in-cheek tweet after this retail sales report saying the Fed is doing a bang-up job slowing household demand, talking about the upward revisions that you were just talking about. And he said that this really puts at risk the market's idea of the terminal rate for the Federal Reserve. Does this shift, this resiliency, shift your belief of how high the Fed will have to go and how long they'll have to hold it, just based on the backward look of the consumer spending and the willingness to keep doing it?
Well, I think the Fed is at a point where they need to be more deliberate and calibrate the Fed funds rate instead of just catching up, right? They were so far behind the curve, 75 basis points, 4 meetings in a row. So I do think 50 is still in the cards for December. But the terminal rate, we're think it goes 5 to 5.25, the range. But the key is, they can hold it there for a very long time and still doing quantitative tightening, as long as liquidity issues don't get in the way of that. But I think, the risk is for higher rates, I think, especially in light of an economy that's still resilient.
Kathy, thank you. Kathy Voss-Janschid there of Nationwide off the back of these retail sales figures. Upside surprise. And Bramwell, I think you're on the right path. The conversation around the terminal rate. This market rally over the last week is built on many things, but one of the things it's built on is the idea that there isn't much upside potential for the terminal rate to go much higher than what is already priced, based on what we got from CPI and PPI and all of the above. And to Neil's point, the resilience story maybe means that story's not over yet.
And that the risk is to the upside, as we just heard Kathy talk about. And is this priced into the market in any way? At what point, the Fed is basically telling us that there is going to be a recession. I mean, they're using different words. They're not using the R word, but they're basically telling us that is going to basically give the market a belief that they have the conviction to go higher.
I don't want to go all Ian Lingon on you here.
But you're going to anyway.
But I won't anyways. But I'm looking at a 2-10 inversion, the vanilla spread plunging, John. Seriously, we're going to very closely go through to a recent record wide inversion on that. And to me, it's not about the 2-year dynamic in the Fed parlor game. It's about the look out there of GDP slowing and the 10-year yield staying down. I'm looking at a nudgy screen trying to figure out where we are on a given Wednesday.
So I'm asking the question, Tom, how big is the window between signs of inflation rolling over? From there, and between how long do you get before the economy rolls over? And right now, we've got a debate. How wide is that window? Is it a month, 2 months? I've heard people tell me it's narrow. Marvin Love of State Street did that in the last hour, and he said buy bonds off the back of it. I think Neil Dutta's pushing back against that.
If it's a longer window, then that means that you're going to end up with perhaps higher rates, right? I mean, if you don't see that slowdown in the data, the Fed's going to keep going, and that's going to cause a much bigger downturn, arguably a softer economy.
Do we have the tools to have that debate? We're in post-pandemic, we're in an absolutely unusual situation, massive supply-side dynamics, not typical demand-side textbook dynamics. We all know that. But are we being arrogant in that we can guess the inflation dynamic over to the slowdown in real GDP dynamic? What tools do we have to guess that?
We've got to be super humble. About the next 12 months.
Well, I think a lot of the media aren't. I think a lot of people are trying to game this thing out as a pivot point. Baloney.
Michael Kushman's going to weigh in on this from Morgan Stanley, alongside Oksana Aronoff of JP Morgan, Troy Gayeski of FS Investment Solutions joining us too. Tweet of the morning from Blue Horseshoe Loves out on Twitter. It's a good handle. Tom knows who Taylor Swift is, yet he can't explain the offside rule of football in the World Cup year. Priorities are all wrong on this show. That's solid feedback, isn't it?
Solid feedback. It's news you can use.
Thanks for listening. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The leaders of NATO and Poland say there's no indication a missile that struck Polish territory, killing 2 people, was an intentional attack from Russia. NATO claims air defenses in Ukraine likely launched the projectile to fend off a Russian assault. If Russia had deliberately targeted Poland, it could have risked drawing NATO into that conflict. Well, Donald Trump says he wants to make America great and glorious again. The former president said Tuesday night at his resort in Florida he will run for the White House a third time.
This is a movement. This is not for any one individual. This is a job for tens of millions of proud people working together from all across the land and from all walks of life, young and old, black and white, Hispanic and Asian, many of whom we have brought together for the very, very first time.
Meanwhile, Republican mega donor Steven Schwartzman won't be backing the former president this time. The billionaire CEO of Blackstone says it's time for the party to turn to a new generation of leaders. Senator Rick Scott will challenge Mitch McConnell for the chamber's top Republican leadership post today. Allies of the two men have been trading blame for the GOP's disappointing performance in last week's elections. McConnell says he has the votes to continue as a Republican leader. And there hasn't been inflation this high in the UK since 1981. October's consumer price index rose more than expected to 11.1% from a year earlier. Soaring energy bills were the big reason. The new data adds to the pressure on the British government and the Bank of England to act. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
There's a general view that, look, yes, the Fed's going to downshift to 50, but there's a little bit further to go. The difference now is where the market is thinking is what is the implication of those Fed hikes today and maybe a little bit more next year? Is there going to be a recession? How bad of a recession? And how bad is the earnings recession going to be? We are expecting the recession to come through in Q2.
Seema Shah, lights out yesterday. Chief Global Strategist at Principal Asset Management there with some heated comments off of retail sales. Market gyrations. Lisa, let's take 2 seconds here to see off of the Fed meeting the other day, curve inversion widens out to a greater inversion moments ago.
We're actually seeing the steepest inversion, basically 2-year yields, the highest versus 10-year yields going back to the 1980s. I mean, we're seeing it sort of reassert itself to 61 basis points, and this really speaks to the conviction that people have longer term, weaker, go by duration, because shorter term, the Fed has conviction to go far, go fast, and break an economy that still has momentum.
A little light humor here this morning as we talked to Mr. Farrow about when the tree should go up, but it does signal to the beginning of the holiday season. And I can state unequivocally on the island of Manhattan, there is no one steeped in this than Dana Telsey, CEO, Chief Research Officer, Telsey Advisory Group, iconic at Bear Stearns years ago. And Dana, I want you to 57th and 5th Avenue, give us one little window into your childhood at Bergdorf Goodman. Give us just one little moment there in your childhood.
I think the moment at Bergdorf Goodman comes from my grandmother working at Bergdorf Goodman and going in and seeing that on the housewares floor, seeing all the different Christmas trees and holiday decorations they have. It changes every year, and it's a wow every year.
We are coming off a pandemic that your grandparents never could have imagined. It was over in 1918. No, it was not. What does the holiday season look like this year?
I think the holiday season, for the most part, is going to be about gathering. I think people want to be together more than they ever have in the past, but I think it's still a challenged holiday season economically. Yes, the retail sales figures came out, but you have a real bifurcation between the high end and the low end. The high end's still spending, but the growth rate of that high end spend is moderating from what it had been in the past. And what we need, you need new product. And who's delivering new product? You and I talked about the trunks exhibition at Louis Vuitton on Madison Avenue. That's new. You look at Deckers, and they have new Uggs platform shoes that are taking off. On running, if you don't have the waffle sole, that is pretty good too.
But that's the luxury sector. This is the people who have discretionary spending. We just saw from the Targets of the world, maybe that's not the case for the vast majority of other people. What is your takeaway in terms of the discretionary spending ability in mass from the Target and Walmart earnings?
It's cautious. When you think about the inflationary headwinds that they don't have the same spending power that they did before, especially when food is going up as much as it did. You look where the value is, everyone's competing on promotion today, which is different than 365 days ago. But you look at TJX's numbers today, which are better than expected, and frankly, even the guidance, it was nice to see how they're setting up. They're getting better brands at more valuable prices. And so is there some share shifts that's going on, and is off-price returning?
It's a great point, especially because we saw, for example, Walmart gain share in the grocery store sector, which actually buffered a lot of their sales, right? Because people are still buying food, and you're seeing that. Where do you expect to see the big share shifts? How much do you see consolidation among the strongest players, and the losers really losing even bigger?
I think overall, when we're thinking about the changes that are going on, who has the assortment and who has value? I think one of the surprises tomorrow could be Macy's, and I think they've been more innovative than they have been in the past, and I think we're going to see some improvement there. I think overall we're seeing on the specialty apparel side, there's newness there. You look at Aritzia, who's been taking share, and I think the issues at the Gap continue to remain headwinds. I think they are share donors, not share gainers in the near term. And I think when we do have all of the changes that are happening. You take a look at Urban Outfitters with Anthropology and Free People, where I think that a little bit higher income and women are buying. I think there's a benefit there. The teen retailers are having issues because they don't have the discretionary spend. So it's a share shift. And let's not forget inventory levels. We have too much inventory. No one is getting rid of it as fast as they would like. And that's going to mean a bargain for the consumer.
So where's the value and equity here? I want to go back to the central statement, which is we talk about, and Lisa needs a pair of statement sunglasses, very important, to have in a recession. Do you go long luxury, which is already richly priced, or do you find value in troubled big box or something else? I don't know.
One of the things I'm seeing with so many of my stocks at 52-week lows, I think investors are doing their homework on the names, preparing for 23 and 24. The tailwind next year is about lower freight rates. The headwind is where.
Give me a single best buy here. You're with us here. No one's watching. Come on, I need a single best buy right now.
When I think of the names out there that are interesting, I mean, I like TJX for what they can continue to deliver, but I think there's other names that are interesting also. When I think of names like, look what Estee Lauder just delivered. If you have to look at some of the value names out there and what could be a change, I think Abercrombie & Fitch. I think the newness that they're delivering.
I was in there the other day.
And what did you think?
I was kidding.
Okay,
You
got
think
it.
I'm going to line up to go in an A&F?
You don't have to line up. You can walk in, and you're going to get a deal.
Okay, that's how
Estee Lauder bought Tom Ford, and that's what you're talking about, the biggest purchase in its history. I am wondering, there is this theory out there put forward by the likes of Morgan Stanley that at some point there'll be a tipping point next year, and these will be the names that will benefit.
To see some of the acquisitions take place in consolidation, but I think you're also going to see divestitures. Some of the companies that maybe not having had performed as well and want to focus on brands that are working. You look at a Wolverine Worldwide, for example, where the Merrell business is their strength. They may not need all the other brands in their portfolio. So I think you're going to see both. And I also think you may see a change up in terms of the physical locations becoming more important. I think stores are the new gathering spots. And what the pandemic did is they basically brought together that people want to socialize. And frankly, you look at as the pandemic hopefully goes into the rear view, that yes, you are seeing people shop at stores. It's one of the changes for holiday 22.
20 seconds. China to the rescue. That's a big theme that's out there, isn't it? Does it work?
Not yet. I'm still seeing China being a tough place for a lot of my brands. I think it's not until 23.
Bring Joe Feldman next time. Dana Tulsi with his Tulsi Advisory Group here. And I just want to say, Lisa, I thought your coverage today here on the differential between Walmart and Target was just lights out.
Well,
and then
thank
there's
you.
TJX.
But what we just heard there was really interesting, and I think it's important to sort of highlight this question going forward of as you look at the product mixes, as you look at the discounts, how you see that consolidation, how you see the haves and the have-nots.
Well,
I think will be really interesting to see, and just, the execution part of this really coming to the fore.
And my theme for the year is the zombie roll-up. We're going to see this now with the interest rates normalizing and the risk-free rate normalizing. The zombies of Dana Tulsi's retail, the zombies in every other sector. It's going to roll up.
And the other thing that Dana said, which I really thought was compelling, was people going to stores and the socialization, because you're seeing that with respect to the online numbers disappointing and the in-store numbers doing really well.
10 seconds here, Lisa. 2s10s just plunging and cratering under 62 basis points. That is absolutely extraordinary.
Yeah, we were seeing
That's a wow statistic.
We're seeing a new curve inversion in terms of the post-crisis era. That is what we're seeing.
Fractional erosion in the market. S&P futures at -11. Dow futures -45. Please stay with us on radio and television. This is Bloomberg. Good morning.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Live from New York City this morning. Good morning, good morning. Downside surprise on CPI, upside surprise on retail sales. Is that good news or bad news? Equities down. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, waiting for growth to crack.
We're going to see the growth slow down. Our expectation in 2023 is that markets are going to begin to focus on economic growth. We're going to move towards growth being a larger concern.
We're going to see pretty sluggish GDP for a while.
The key issue at the moment is the sequencing of hitting the Fed's dual mandate.
The investable windows are really, really short. This is not a time to get too cute. It's the window between, hey, inflation looks like it's peaked.
We have seen now inflation come down.
And, the unemployment rate is rising and other forms of economic growth are slowing. That's going to give cover for the Fed to pause in Q1. The big risk that we see is that the lags between monetary policy tightening and the effects in the real economy. I don't think you catch it fast enough until the second half of the year. You're going to see a big lag, and that's going to be a bigger problem. It's going to be very difficult for markets to digest.
This economy's not breaking yet. Joining us now is JP Morgan's Oksana Aronoff, Morgan Stanley's Michael Kushner. Oksana, first to you. Downside surprise on CPI, upside surprise on retail sales. Isn't that what we want to see?
Well, it's interesting. In the preceding segment, you ran through a number of people who are talking about the expectations of a slowdown as we move towards 2023. And yet, this is the fourth pivot rally that we've seen so far this year. And yes, the Fed's job is not being made any easier by all of this different data. The stronger retail numbers today give them more cover to continue to be aggressive, which is what they have consistently telegraphed, right? I think Jerome Powell left no doubt whatsoever that he prefers to err on the side of more tightening as opposed to less tightening, because more tightening he feels he can undo with easy monetary policy, whereas less tightening is an error that will take years potentially to undo.
Neil Dussel of Renaissance Macro on the same page as you. He said out on Twitter, it puts the market's estimation of the terminal interest rate at risk. As Powell has said, we don't know what the path will be, but we know it will be enough. Michael Kushner, how do you think about that? The risk that the terminal rate has to go even higher?
Well, I think what we've seen today with lower inflation, higher retail spending is indicative of the risk of higher short-term rates farther out. Inflation is coming down. We're seeing goods price disinflation. Certainly one major factor holding back spending has been high prices of things, whatever you were looking to buy, or the inability to actually buy it. As inflation comes down, supply chains continue to loosen, people are confronted with lower prices and availability, spending could actually be firm. And we're seeing that in the second half of this year, the economy is going to be accelerating relative to Q2 into 2023.
We're trying to work out the gap between inflation rolling over and growth getting smashed, and that's been a theme on this program over the last 48 hours or so. We caught up with Jared Woodard of Bank of America. Take a listen to what he had to say.
The big risk that we see is that the lags between monetary policy tightening and the effects in the real economy could be much longer than investors have priced in. I think you're going to see a big lag, and that means it's going to be very difficult for markets to digest both slowing growth and tighter financial conditions at the same time.
Oksana, let's say that weakness is pushed out further into 2023. The real big, profound cracks in the economy, in the distance, on the horizon, out into, I don't know, the first half, second half of 23, whatever it is. What do you do in between, Oksana?
So I think this is a really important point, John, which is that it's sort of irrelevant. I know there's so much emphasis on, has inflation peaked? We frankly don't know. We had a similar feeling, or the market did, wasn't my view, but the market did in the summer, and then we resumed the trend upward. So we really don't know. And it's sort of irrelevant because, of course, there are significant lags to Fed policy, lags as long as 12 to 18 months. And so we won't really see the full effect of this tightening probably until, possibly even the midpoint of next year. And if you think about those lags being, 12 months long or so, where was the Fed 12 months ago? They were fully in easing mode. And so this past quarter was really the first time that we saw inklings of the Fed's tightening have an impact on earnings. Of course, Target most prominently coming out this morning with a pretty dreadful report, right? And so we're going to continue to see that. And I think to your question, what do you do between now and then? You stay very defensive because nothing has really broken in this market yet. And this Fed is not getting involved until it does, and even then, only if inflation is fully under control, which is absolutely not where we are at this time. So stay very defensive.
Push that through the bond market, Oksana. The inversion we've got on 2s versus 10s right now at negative 63. How much further negative can that go?
So we actually think the curve will start to flatten out at some point. And again, irrespective of that, what we really should be prepared for as investors is that there's going to be more pain, certainly on the corporate credit side of the market, where earnings will continue to get squeezed, and there will be really great entry points at that time. I know that right now the favorite trade seems to be, buy longer-term treasuries because that's going to protect you should that recession materialize, a word that the Fed is all but outright saying that is essentially what they're playing for. But, I'm not so convinced because the only reason to buy 10-year duration here is certainly not because you're picking up yield, because, as you said, the curve is inverted. The only reason to buy it is if you believe the Fed will start cutting and you're going to sort of accrue that appreciation that has been the case in past cycles. And I'm not so sure the Fed will be free to do so, again, if inflation stays elevated, and that doesn't even mean it needs to stay at 8%. It could be at 4 or 5, and the Fed will not be free to really cut, and you can have more of a stagflationary scenario in which, that longer-term bond is not really the safe haven that everyone expects it will be.
Michael Kushma, your reaction, sir?
It's a similar view that this bull flattening we've seen of late with relaxation of expectations of Fed rate hikes seems premature. There's still a lot of uncertainty how things are going to play out in the next couple of quarters, and particularly lower inflation, easier supply chains could lead to stronger spending and a harder job for the Fed to rein things in, so that I expect the curve to kind of go back to kind of where it was. 10-year treasuries where they are now seem on the low side relative to where they should be. I think over 4% is a more realistic level to buy or to own duration in this environment. That there's too much optimism that we're going to have a soft landing next year.
Raphael Bostic echoed some of that. The Atlanta Fed president said this: there is considerable uncertainty about how these policy lags will play out. We're still learning about an economy that is rapidly changing. It can take many months for these decisions to take effect, and for the economy and on prices as well. Mike McKee, your thoughts?
Well, the data we got this morning certainly backed that up, the idea that the Fed doesn't know exactly what's going to happen because the economy is rapidly changing. Look at the retail sales figures. Very strong, 1.3% after a flat reading in September. Now, some of that is inflation, but a lot of it is people still buying stuff. The Retail Control Group, which goes into GDP, up 0.7 an increase from September. And then you look at the import prices, ex-petroleum, because that's very volatile, down 0.2%. Autos in the retail sales report up 1.3%. This may be a lot about cars because, of course, Florida had 2 hurricanes, insurance paying off, and maybe people buying new cars. Gas prices we knew would be up. But look at groceries, still strong. Department stores surprisingly weak, but that is coming after the back-to-school sales. Non-store retailers, the internet guys, 1.2%, and the only services thing in the categories here, 1.6% for eating and drinking, which is the most discretionary of all. So if people were feeling bad or thought they didn't have money, that is where they would cut back. And look at this number. Came out yesterday, the New York Fed, credit card usage in the third quarter. That shows credit cards are becoming a bigger and bigger part of retail spending, which does suggest that stimulus money is running out, and maybe we're going to see people running up their credit cards to try to keep up the spending, and then they get a bill and they decide we're not going to spend anymore. But that's still to be seen. And the dilemma is summed up this morning and last night by Esther George, the Kansas City Fed Bank president, who said she's not in her 40 years seen a time of this kind of tightening that you didn't get some painful outcomes. In other words, a very rising unemployment rate. And then look at what Target said today. Lousy third quarter, $3 billion restructuring. And they say, yeah, but we're not planning any layoffs. It was so hard to find workers after the COVID pandemic that people aren't letting people go. Well, how does that change the dynamic for the Fed? This is going to play out over several months and be really interesting. By the way, John, this morning, Michael Feroli over at JP Morgan said they expect another 100 basis points of tightening from
another
the Fed
100
and a recession next year.
5 handle on Fed funds. Yep. They're all looking for that. I remember someone said weeks ago, you can't fire what you couldn't hire. Mike McKee, and that seems to be the theme in corporate America. Mike, you mentioned Target. In the pre-market, that's now by more than 15%. Compare and contrast what we got from retail sales 40 minutes ago and what we heard from the Target CEO just before that. In the latter weeks of the quarter, sales and profit trends softened meaningfully, with guest shopping behavior increasingly impacted by inflation. Can you compare and contrast that, Mike, for us?
Well, you look at Walmart, and Walmart didn't have any problem with those things. There was some retail analysis out this morning that said Target may be something of an outlier. Now, interesting thing is that these are all sort of the lower price level stores that are reporting now. And so maybe what we're seeing is people buying more groceries and fewer bits of apparel and things like that because their discretionary income is being squeezed a little bit.
That stock getting hammered. We'll pick up on that around the opening bell. Oksana Aronoff, Michael Kushma back with us for a final thought. Oksana, you said there would be better entry levels. Can you describe them to me? What does that look like, and how the hell do you know when it's the right time to come back into this market?
So if we look at just simply history, and if we look at parts of the bond market that tend to break first, right, and that's certainly the lower rated credit issuer, what we see there are spreads in the mid 400s, and that's below the 20-year average, let alone below a recession average, which tends to run in the high 800s, low 900s, irrespective of how shallow or benign that recession is. So we have not really seen any pain there, and it's really telling and concerning, frankly, to me that we saw, last Thursday when this sort of rally really ripped, we saw $2.5 billion go into high-yield ETFs, and they have now garnered something like 22% of their AUM since just the mid-October. And this is all happening as downgrades are taking over upgrades in that sector, as, again, we're just starting to see that sector really reckon with a new order of higher cost of capital, and this is not a part of the market that really can thrive when capital is expensive, given that these are junk issuers. So I think, using that as just sort of one example of the kinds of entry points that we will see as some of this pain does start to take toll on earnings and margins, et cetera. So we will absolutely have better entry points in the coming weeks and months, but it's going to take some time. In the meantime, we do see pockets of markets that are breaking. If you look at the CLO market, if you look at pockets of the mortgage credit market, if you look at some closed-end funds, you do see these sort of isolated canaries in the coal mine, and that is going to spread more widely, and that contagion will continue. And look, we're not describing something akin to a 2008 type event.
Sure.
But certainly liquidity concerns will enter this market again, and certainly there will be better entry points as the reality of the higher cost of capital continues to just grind down earnings. And we are just at the beginning of this process. And again, whether inflation has peaked or not is irrelevant to that reality, that we're going to have to live with this for the next months and possibly even a couple of years.
Michael Cushman, I've got 30 seconds for you, sir. Final word.
This year has been about rate increases, not about corporate default probabilities increasing, et cetera. The economy's been overall weak, but household and corporate balance sheets have been in really, really good shape. Everyone turned out their debt. Rising interest rates is not affecting balance sheet or financial health. Therefore, rates have impacted rate-sensitive sectors like the mortgage market, housing market, things like that. But overall, the default risk, earnings risk is next year's problem, not this year's problem. So the rally we're seeing in credit, in high yield and investment grade is not likely to be sustained next year, with spreads getting back to more normal levels at a time with very heightened uncertainty with regard to the outlook for the economy, certainly in the latter half of next year. So overall, I'd be pretty defensive, getting more defensive now, and take advantage of the rally to lighten up risk in anticipation that next year is going to be a rockier road with regard to credit.
Michael, Oksana, to the both of you. Two of the best in fixed income. Great to catch up. These moves in bonds today. 2s, 10s, negative 63 basis points. That curve going even more negative. Coming up, panic over Russia tensions receding.
We have no indication that this was the result of a deliberate attack. We have no indication that Russia is preparing offensive military actions against NATO.
We'll touch base with AMH and Maria up next.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
We agreed to support Poland's investigation into the explosion in rural Poland near the Ukrainian border. And I'm going to make sure we figure out exactly what happened. And then we're going to collectively determine our next step as we investigate and proceed. There was total unanimity among the folks at the table. It's unlikely in the minds of the trajectory that it was fired from Russia. But we'll see.
Attention shifting from Bali to Poland, escalation fears easing following an explosion near the Polish-Ukrainian border.
We have no indication that this was the result of a deliberate attack. We have no indication that Russia is preparing offensive military actions against NATO. Our preliminary analysis suggests that the incident was likely caused by a Ukrainian air defense missile fired to defend Ukrainian territory against Russian cruise missile attacks.
This coming as world leaders wrap up G20 meetings and President Biden returns to a lame duck Congress. Our team coverage begins right now with Anne-Marie over in Bali, and with us from Brussels is Maria Tadeo. MH, first to you. The events of the last 24 hours, what are the lessons learned?
I think the lessons learned are that the U.S., along with the G7 leaders and the NATO leaders, really wanted to work on making sure they had the facts right before they escalated a situation that was obviously incredibly worrisome. And really what you saw from this morning to right now this evening is really the Western alliance moving back from the brink. There was discussion of Article 4, discussion of Article potentially 5 lingering out there. But what they did and what the president discussed with reporters was that they wanted to wait for the assessment to be done. And that's what they did. And what they found out was that, Jonathan, this was the preliminary investigation. This was a Ukrainian defense missile that was warding off a Russian missile. Now, one thing that is very clear, whether it's Chancellor Olaf Scholz, whether it's President Biden, whether it's Jens Stoltenberg, is that they say Russia in the end bears responsibility because, of course, this is the 9th month of the war in Ukraine, and that's Putin's war in Ukraine and his invasion.
Maria, there is a tweet from the Ukrainian foreign minister that is still up from 16 hours ago that says Russia now promotes a conspiracy theory that it was allegedly a missile of Ukrainian air defense that fell on the Polish territory, which is not true. Except we found out that preliminary investigations suggest it might be. What's your take on that?
Look, Jonathan, it's very difficult here because you have to understand the political situation, just the emotional situation in Ukraine right now is very difficult. We need some context here. Yesterday was a terrible day for Ukraine. This country was pounded by Russia in what looks like retaliation for isolation at the G20. And of course, the fact that the Ukrainian army was able to get back Kherson, that was humiliating for the Russian army. So this is a country that is still reeling in so many ways for what was yesterday just a pounding across the country. Now, the Ukrainians, of course, are always very sensitive to this perception that maybe they are the bad ones or the ones that do not do everything correctly or the right way. And this is why you see, the Ukrainians, to some extent, on the passive-aggressive saying, well, do not buy anything that Russia says. How can you believe that Russia says it was Ukrainian air defense and take their words? Moscow lies all the time. But I should say something. The fact that this was a Russian missile air defense does not mean that Russia does not bear responsibility. This goes back to what Anne-Marie said. A lot of this is happening because of Russian actions. It doesn't mean that Ukraine doesn't have a right to defend itself, but of course, the country's a bit on the passive aggressiveness today.
It's a tough one. Maria, thank you. Alongside AMH, two of the very best on this story over the last 12 months, that's for sure. Ed Mills with us now, down in Washington policy analyst at Raymond James. Ed, I want to talk to you about the Washington that the president returns to and the support or lack thereof that there will be in Congress to support funding Ukraine's effort to defend its territory.
Well, John, I think he returns to a Congress that will absolutely continue the funding. I do think it would have been different if Republicans made more gains, especially in the House. You did see some of these questions that were coming up pre-election, not only from the MAGA Republicans, but also from the progressive Democrats. But I think the lesson from the election was the middle held. The middle is what is going to govern over the next 2 years. In the middle continues to support the efforts in Ukraine. And the incidents yesterday are thankfully seemingly like an accident, but it is a reminder of just how close we are to escalation, and that will redouble kind of efforts and support here in D.C. For the support of Ukraine and against Putin and Russia.
And a reminder in the last 24 hours as well over how divided this Republican Party might be in the House. Ed, your take on the former president announcing that he is going to run for 2024, and the announcement we had from Stephen Schwartzman of Blackstone in Axios today that he probably won't be supporting him.
Yeah, John, this has been a remarkable kind of week for a lot of reasons, but it has been a coordinated effort by Republicans and from the media that have supported Republicans to tell Donald Trump that they do not want him to be the nominee in 2024. Ultimately, that's clearly up to voters. If there is something that I hear from Republicans here in D.C. about the 2024 election in President Trump's emergence, is if he does not get the nomination, would he run as a third-party candidate? Does that help out Democrats in the 2024 elections ultimately? Clearly, it's too early to kind of tell on a lot of these things, but his emergence is not a welcome sign, at least from Republicans that I speak to here in D.C.
Ed, the primaries will be fascinating, and I think I'm probably underplaying it on the Republican side. Do you think we will have primaries on the other side?
If President Biden decides to run for re-election, there might be a primary, but I think he would have the opportunity to kind of relatively easily capture the nomination, especially after how he did in the midterms, and chalking up some, surprising wins over the last 2 years with a very small House in a 50-50 Senate. Clearly, if he decides to step aside, we will have a very robust primary. Is it the vice president? Is it some of his cabinet members? Plenty of governors and senators would also enter the race. So it's going to be a fascinating couple of years here.
Looking forward to covering it with you, Ed. I know you've had a super busy morning. Thanks for dropping by the studio for us. Ed Mills there. Equity futures down 0.4% on the S&P. Up next, your morning calls, and later, Target hammered.
Satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Equities down. Let's get you some morning calls this morning. Jefferies cutting their Apple estimate, saying it's taking a weekly revenue hit of $1 billion due to lockdowns. Evercore adding Etsy to its underperform list, expecting customers to shift their spending to cheaper items. And finally, Raymond James downgrading Home Depot, highlighting a number of challenges in the year ahead. That stock is down by about 1% in the pre-market. Up next, Target plunging after earnings and sounding the alarm on the U.S. consumer. That conversation up next with Troy Gayeski of FS Investments.
activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're processing a ton of information. CPI downside surprise, PPI downside surprise, retail sales really punchy. Upside surprise, equities down by 0.4% on the S&P. On the Nasdaq, we're down by 0.7% over the last week. The rally in that one has been monstrous. That's the equity market. That's the opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year. A 10-year Treasury yields lower by 5 basis points, 371.94, and the dollar weaker once again. Euro dollar 104. In the commodity market, we're down 2% on crude, $85 and about 11 cents. And the only stock to watch right now around the opening bell, about 10 seconds in, is Target. And Target is getting hammered. We're down by more than 16% at the open. Target's results fueling concerns about a U.S. consumer this morning. The CEO, Brian Cornell, had this to say: in the latter weeks of the quarter, sales and profit trends softened meaningfully. Katie Lyons, every time Brian Cornell smoked this morning, it was bad news after bad news.
Yeah, it's definitely bad news for Target today. The shares are getting absolutely destroyed at the opening bell. You're down about 16%. But what's interesting, John, is that this is not universal among retailers at this point.
Kaylee, we've got to turn your mic on. We're going to sort that out in just 2 seconds' time. And when we work that out, I'll bring you back into the conversation and we can talk some more about Target. Troy Gajewski's with us now. Troy, I'm going to come to you on Target. And what we've heard from Target this morning, which is just bad, 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 and what we've heard from retail sales, which was pretty good. Mix it all up, Troy. What'd you get?
Yeah, so I think, one of the points of this cycle that's so interesting is that, remember the U.S. consumer, because they were flush with cash, as well as a hyper-tight labor market really up until the summer, has been keeping the U.S. and global economy afloat throughout a very tough period. And that continues to upside surprise. As you were talking about earlier today on surveillance, the more resilient the consumer remains, the harder the Fed goes in terms of tightening policy. So we could stay in this more inflationary environment for longer because the labor market and the consumer have been incredibly resilient. That being said, if you think about Target's results, it really just reemphasizes that, it's not necessarily a Wile E. Coyote moment, but at the same time, the consumer can't keep it going single-handedly forever. And as the labor market gradually softens, unemployment goes up, not only are you going to have disappointing earnings at the corporate level, but ultimately next year, in agreement with Dudley, it's almost inevitable that we end up in a recession because the U.S. consumer, with a softer labor market, with unemployment going up, cannot single-handedly keep the global economy going forever.
So, Troy, how wide do you think the window is? And this is my question of the moment this week. How big is that window between evidence of inflation rolling over, and we're getting signs of it at the moment, and growth cracking? How long is it before this takes place?
Yeah, so if you asked us 3 months ago, we would have thought it was, Q1 to Q3 is when we finally have, quote unquote, a true recession where unemployment actually goes up meaningfully and consumption rolls over. Because without job creation, income growth, and higher debt levels and inflation, it's inevitable that consumption rolls over. Now it's looking more like a Q2 to Q4, maybe even as late as Q1 of 2024. So we're going to stay. The lag is quite profound, right? And again, if you look at the data, and one of the data points we always follow very closely is withholding tax growth. So that's rolled over hard, but it's still at relatively healthy levels compared to the post-pandemic era of mid to low high single digits. So again, first of all, job growth slows. Ultimately, we have more layoffs exceeding job creation. That should go negative, and that could be as early as Q2 of next year, but as late as Q1 of 2024. So it's a very wide band in terms of when the next recession is actually declared.
So Troy, if it is that long, let's explore the terminal rate a little bit further. I mentioned this morning. Neil Dutcher of Renmac was speaking to Lisa, and he said it puts the market's estimation of terminal interest rates at risk. As Powell has said, we don't know what the path will be, but we do know it will be enough. So, Troy, can you help me understand the upside risk here? Because I think a lot of people were getting comfortable with the idea that it was kind of 5 and that was it. And that was the bulk of the cycle and we were done.
Yeah, look, I mean, clearly every estimate, particularly from the perma bull crowd and the transitory crowd, has been wrong up until recently. The good news is inflation has peaked, right, in terms of CPI. Still need confirmation on that in terms of PCE. But the bad news is it's fully spread to the labor market and services, right, which is why the Fed has to go so much harder. So, our point to clients here is that, look, if you're going to stay at the short end of the curve, focus on strategies that have slightly above risk-free with tax advantages like senior secured commercial real estate debt. And if you're going to lean out further on the curve in terms of risk profile, make sure you're getting paid an abundant level of income to either tolerate higher rates or participate in higher rates. So, ultimately 5 to 5.5 at the front end and, a 4.5 to 5% 10-year is certainly a reasonable part of the distribution unless inflation continues to roll over extremely hard, which we just don't see it doing given how fully embedded it is now in labor and services, which takes quarters and quarters to break, not months and months, John.
Well, Target's breaking, that's for sure. We're down by 15%. About 5 minutes into the session, and Katie Lyons, I understand we've got the microphone dialed up for you now. It's not the first time we've seen this take place this year, is it?
No, Target has had a few brutal post-earnings reactions, and this is one of them, with the stock down double digits in the first few minutes of trading, John. It's so interesting to contrast Target with what we saw from Lowe's earlier today as well, which looked okay, Walmart, which looked okay, retail sales, which say the consumer spending is actually holding in there, but Target is not experiencing it. Missed huge in the third quarter when it comes to profits, and its cut outlook for the top and bottom line in the holiday period. They actually think comp sales are going to decline in this holiday quarter. That would be the first time that's happened in 5 years. As you read the quote from the CEO, they say that this is an inflation and consumer behavior problem shifting in the face of it. But really what it comes down to is the product mix as well. If you look at the retail sales data today, you saw upticks in a lot of areas, but you didn't in general merchandise and things like electronic stores, things that Target has a little bit more exposure to, apparel, for example. And as a result, they have too much inventory of things consumers no longer want. As they tighten their purse strings, they have to mark down in order to work that inventory down, and that is what is weighing on profit here. And while analysts say a lot of this may be company specific to Target, we know it is not the only company grappling with the issue of inflation. Really, companies across the board are feeling it, including in technology, where those tightening purse strings mean that customers, whether they be consumers or companies, may not be shelling out money on new hardware and tech spending or ad spending for that matter. But there's also the secondary effect of inflation, which is that central banks want to fight it by raising rates. And we know those higher rates put additional pressure on the stock of some of those technology companies as well, John.
Hey, Katie, it's the question we'll ask all day, I guess. Is it execution or the environment right now? Katie Lyons, thank you. Target, about 6 or 7 minutes into the session, is down by 14%. So much news on Apple recently. The latest yesterday is that Apple was offering a discount of as much as 10% on MacBook Pros, according to businesses and Apple retail employees. The latest this morning, this from Tim Cook, the CEO. We've already made a decision to be buying out of a plant in Arizona. He's talking about chips. And this plant in Arizona starts up in 24. So we've got about 2 years ahead of us on that one, maybe a little less. Apple preparing to pivot from its reliance on Asian suppliers. Ed Ludlow has more on this. Hey, Ed.
Yeah, it's likely that that plant is the plant TSMC is building in Arizona. Remember, we reported just last week that actually TSMC is currently building a plant in Arizona and actually plans a second. Intel is also building a plant in Arizona, but it's unlikely that Apple will pivot back to that previous supplier. We know about this because of remarks that Bloomberg News has seen made by Tim Cook. He was talking to employees in Europe and also added that in the future, Apple could also move its supply chain base from Asia to Europe as well. Remember, it's heavily reliant on TSMC chips produced in Taiwan as it stands. Another piece of key Apple news this morning, John, that caught my eye. Jefferies out with a research report saying the lockdowns in Zhengzhou, where Foxconn assembles the iPhones, could be hitting Apple to the tune of $1 billion of lost revenue a week and shaving off about a cent of EPS for each week that passes. So that's more an issue of labor and operational supply chain disruption in the short term in that market. But if you go on EEO on the Bloomberg terminal, you can see that estimates are coming down for Apple expectations, not just for the current period, but also for full year calendar 23, because of what we're seeing in the short-term disruption in China. But it's interesting to see this play from Cook, reacting to secure Apple's long-term supply chain base.
Ed, thank you, sir. The structural changes we're seeing right now, huge. We caught up with Jared Woodard yesterday at Bank of America on this. Take a listen.
If we're right that we're under, the very early stages of a big macroeconomic shift, then the valuation reset could be substantial and it could be prolonged. 2 decades, $70 trillion of assets invested for a 2% world. How many analysts, how many investors have reset their valuation models, their discounted cash flow frameworks for a world with higher interest rates, higher cost of debt, higher rollovers in the bond market? And if you do those resets, you reset those models, I think you get very different valuations than where the market is today. It's not a time to fade what could be a major structural shift.
Troy, I'd love your input on this. Jared was talking about globalization ending, reversing after 10 years plus of it, decades of it. Low rates, 2%, a world of 2%, abandoning it, and the valuation reset, Troy, that he thinks we're only just starting to have, beginning to have, but ultimately haven't completed. Do you share that view?
Yeah, 100%. And whether you look at broader markets, which have rallied back up to 17 to 17.5 times forward earnings, that's only cheap in a QE world where the Fed is pumping in massive amounts of liquidity. If you go back and look at longer periods of history, it's not cheap at all. So there's certainly more multiple compression to come after this recent bear market rally. And then in terms of globalization, again, we still think people underestimate how critical that was, not only for suppressing inflation, right? The Chinese labor market was the biggest inflation suppressant, one of the biggest reasons why the Fed struggled to get inflation above 2%. So you're losing your biggest inflation suppressant, which basically means 3 has got to be the more rational target going forward for inflation as opposed to 2. And secondarily, corporate profit margins in the S&P went up from 5.5% to 12 to 14%, not driven exclusively by globalization, but driven in a large part by globalization and more efficient supply chains and cheaper labor and also cheaper borrowing costs. So, this is a very different world, and that's why, investors have to rethink their total asset allocation. The majority of your assets should still be focused on Northwest Quadrant strategies, accept lower returns, take lower risk. And if you're going to reach out for more risk, just make sure you have an abundant amount of cash flow that will help you tolerate mark-to-market volatility. And if we're dead wrong, and your prior segment was dead wrong, and we did just start a new bull market, at least you'll have some upside capture given how low prices are relative to the last 5 years.
Troy, I'm trying to gauge capitulation. The client's receptive to this.
Yeah, so I think clients, particularly over the last 12 to 15 months, have recognized that, ultimately a lot of the 2021 gains, what we call the green light go environment, were unsustainable, and that you should at least think about rotating up the capital structure in real estate and locking in gains or locking in some gains from equities. The biggest pushback, John, though, we got last year was actually taxes. You don't want to pay taxes. It's like, well, that's not a problem anymore because there's a lot of tax loss harvesting. So we're seeing that more. And I think, unfortunately in fixed income, because yields haven't been this high for so long, there's been an urge to average down into oblivion and reach out for more and more duration. And even though, the bulk of the yield move is behind us, the biggest driver of returns on long duration instruments is not income. it's rate moves. And if rates continue to go higher, you can withstand a pretty substantial shock. So, I think gradually this realization of a new Fed regime, higher inflation, deglobalization is starting to resonate. It just takes time for people to get over, a 13-year Fed-induced, asset inflation extravaganza.
We're deeply conditioned by it. It's deeply ingrained. Troy, you've got to stick around. Troy Gajewski, I'm happy to say, is going to stick around. Equities are down 0.4 on the S&P and the Nasdaq down 0.9%. Coming up, a lawsuit adding to the FTX fallout.
All of that stuff, that ecosystem, is going to come into the regulated institutional environment.
That conversation up next.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And fundamentally, it's done through the equity markets.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What's going to happen? All of that stuff, that ecosystem, is going to come into the regulated institutional environment because it's just too risky to sit out with a bunch of cowboys who have managed to blow themselves up.
The FTX crisis shaking confidence in the crypto world. The company and its founder, Sam Bankman-Fried, slapped with a lawsuit claiming the platform targeted, quote, unsophisticated investors. This as Genesis becomes the latest to take a hit, suspending withdrawals at its lending arm, saying it's facing, quote, abnormal withdrawal requests. Shonali Basak on top of the story with us now. Hey, Shonali.
John, as if FTX wasn't enough, remember when we talk about Gemini, which is the company run by the Winklevoss twins, and Genesis, which is one of the biggest players in the space, the stopping of withdrawals is a very big deal. Remember, Gemini was a company just a little while ago was offering 8% yields on an earn product, a lending product, a savings product really for customers, and now customers can't get their money back in the near term. The question is are these solvency issues or are they liquidity issues, and what is the next shoe to drop? As far as FTX itself, you mentioned that class action lawsuit. That also includes celebrity backers, including Tom Brady, Steph Curry, Shaquille O'Neal, Gisele Bündchen. Listen, this is going back to this idea that the celebrity endorsers were being used to really get to more unsophisticated investors, and that is the heart of this lawsuit. Remember, more than 1 million creditors are named in this Chapter 11 filing that could be on the line here for money lost. In the coming days, we'll see who the top 50 creditors are and how far that exposure really goes.
Cascading failures, Shonali, and the bleeding. Where does it end? Where does it stop? And how big is this iceberg?
Between the latest announcement by Temasek of almost $300 million lost here, the tally for large global investors is quickly hitting $500 million, could become much more as more is announced. I would also say Mike Novogratz had told me late last week after the bankruptcy filing of FTX, he thinks that the Lehman analogy of about 6 months after could be a good barometer here, or some sort of barometer on how far we can see the contagion continuously going. Remember, more companies are at risk of bankruptcy itself, so that million customers for FTX add on the customers that could be implicated here in future bankruptcies of other firms tied to this fallout.
Shonali, thank you. Appreciate it. Great work as always. One thing you'll never see on this show, on this program, celebrities endorsing financial products. I hate it. Troy Gayeski joins us right now. He's back with us. Troy, I remember your old seat when you let Bitcoin grow to, I think, plus 10% of the overall portfolio. Can you talk to me about lessons learned at the moment over the last year?
Yeah, so I think that, the key, there's really two keys to if you're going to own crypto, right? The first is, are you in it for a multi-year cycle? Meaning you're not concerned about the 4-year halving cycles. You can tolerate massive levels of volatility. You're going to stick with Bitcoin in particular, which is obviously the most resilient of them all. And then just ride out the cycles, right? And so there are access vehicles that allow ultra high and high net worth individuals to do that with very good custody. Or are you going to trade the cycles? And, that's a very big key in that, look, if you're going to ramp up risk or take risk down, Bitcoin historically has had very defined cycles around the halving point. When Bitcoin halves, new supply is cut in half. This cycle was exceptionally driven by Fed policy as well. So that can lead to very big gains. But then the downside, of course, is when supply continues out at a pace regardless of price, you can have these disastrous bear markets, which has been the history of crypto, and there's no reason to expect that to change. So we think the next attractive entry point could be late 23, early 24, around the next halving. And then it's just a question for investors in terms of their risk profile. If they're going to make a very tiny allocation and can ride it through a cycle, no problem. Just accept that you're going to have higher highs and higher lows and wild volatility. But actively, trading around the peaks of the cycle and the declines for more active investors makes a lot of sense.
Troy, how does the reputational risk assessment factor into the risk-reward assessment? From a personal standpoint, for an individual right now, like yourself, who would put money into, say, a questionable platform that blows up like these have in the past, do you have to take account of that a little bit more?
I think so, and I think that's probably one of the bigger surprises about this cycle, especially with the evolution of institutional custody at places like Fidelity or NYDIG or Galaxy that really made it accessible for institutions. The fact that you still have this prevalence of bad actors, which, obviously there's no other way to describe FTX than that. It's a real stain on not only the crypto community, but also, those that funded it. And it's really, really unfortunate. So I think, going forward, what that could mean from a price standpoint is the next halving cycle takes longer to get going because it might take 3, 6, 9 months to wash through this current saga. And that's going to greatly reduce the willingness and ability for institutions to invest. And then furthermore, John, this is back to this whole concept of cash flow is king now. This is an environment like 20 or early 21 where most assets were expensive, yields were low, and you were playing for positive convexity upside to the Fed. This is an environment now where, whether it's closed-end funds like FSCO or listed BDCs like FSK offer exceptionally high yields. So if you're going to take risk, at least get paid cash flow. Whereas in 20 and early 21, a lot of those opportunities weren't present. So very different market environment today. So if you're an institution, like, are you going to buy the 10-year at 3.5 or 4? Are you going to buy high yield at 10? Are you going to buy closed-end funds? Are you going to buy senior secured commercial real estate debt? Or are you going to risk some reputation on stretching for stretching for return in crypto? Much tougher call.
Right now, you're not going to make that call, that's for sure, given what's played out in the last week. Troy, I know you've got a new credit strategy, and this is the tease for next week. We're going to talk about it next Wednesday. Troy Gayeski of FS Investments there. Want to squeeze in some sector price action. Abby, stocks are lower. Break it down for us.
Yeah, very interesting, John. We do have the S&P 500 down about 0.6%. Low volume. Sector-wise, it's very interesting because 8 of the 11 sectors are down, but the 3 sectors that are up, that's true defense. Utilities, healthcare, consumer staples. Of course, discretionary being weighed on by Target, the nice to have not weighing out on the need to have. And then advanced auto also down about 15%. Its worst day since March of 2020.
Abby, thank you. Stock's a little softer than your trading diary. Up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
The moves in these markets, phenomenal. Equities lower by 0.6% on the S&P and the Nasdaq down by more than 1%. Take a look at the gap in the bond market between a 2-year and a 10-year. That gap, deep inversion, negative 63 basis points, 2s versus 10s right now. Post-retail sales, that's the price action. Let's get you the trading diary. Fed Vice Chair for Supervision, Michael Barr, testifying on Capitol Hill at the top of the hour. Fed Governor Waller speaking at 2:30 Eastern Time. Another round of claims coming tomorrow morning, and we'll hear from the Fed even more. Bullard, Bauman, Mester, Jefferson, Kashkari, all on deck. Then on to Friday, existing home sales and Fed President Collins speaking to round out the week. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in prize stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony and including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
Kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system. If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word.
Connection
because
lost.
TikTok listens to us. The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse. How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas.